Hi candidate, welcome to Manifested Online Classes. My name is Joseph Kemani, your lecturer for Advanced Financial Reporting and Analysis. So remember, this is one of the units which a candidate is expected to sit and pass at the advanced level of CPA. And the objective of this unit, or the objective of this paper, number one, is to help the student to account for complex financial transactions. These financial transactions include accounting for things like deferred taxes, accounting for things like financial instruments, and so on. Number two, a candidate should also be in a position to prepare complex or basically advanced financial statements, both for private and also the public sector entities. These include now the entities which are operating within the public sector, like what if as the county government, the national government, what if as the NGOs or the not-for-profit making organizations, and also a student should be in a position to prepare things like the group account and so on. So the other objective of this particular unit here is to help the student understand the current trend in accounting. For example, issues to do with sustainability reporting, issues to do with what we refer as the integrated reporting. So therefore, those are some of the objectives of this particular paper. And once the student sit and pass this particular paper, that particular student, number one, should be in a position to prepare the group accounts in accordance with the various international accounting standards and also in accordance with the various international financial reporting standards. So I mean that once you have done this particular paper, you have passed this paper, you should be in a position to prepare group accounts in compliance with the various accounting standards. Number two, also a student must be in a position to prepare financial statements of various entities, including entities which are operating in private sector and also operating in public sector. Number three, a student should be in a position to analyze financial statements using various techniques, such as computing things like earnings per share, preparation of something called the segment report, both for private sector entities and also the public sector entities. And also a student must be in a position to account for complex financial transactions. I've mentioned some of them, including accounting for deferred taxes, even at the group level, accounting for things like leases, accounting for things like financial asset and financial liability. So therefore, those are the running outcomes. So once you have done this particular paper, and by the end of the day you have passed advanced financial reporting, then those are some of things you should be in a position to do. So in course of covering this particular syllabus, I will be providing summarized notes for each and every subtopic. And this particular unit here do have a total of 7 or a total of 6 topics, and each topic do have a number of subtopics. So what I'll be doing, I'll be providing a summarized note on the same, and also I expect that in course of covering a certain subtopic, you should also be in a position to take your own notes. And once we are through with a certain subtopic, then we will be doing some illustration questions. Usually, this particular illustration questions which we will be doing as far as this particular subtopic are concerned come from the Kasneb past papers, and actually the most recent Kasneb past papers. And also, other than doing a question or doing illustration question for each and every subtopic, I'll also be giving some assignment equally from the Kasneb past papers, which I expect you to attempt so that you can be able to have a detailed understanding of those particular sub topic. And in case you have any challenge in terms of tackling those particular illustration questions, or basically those particular assignment which I'll be giving in class, I usually encourage my student to procure our revision partner. We have a revision partner which is actually updated to the most recent sitting. So I usually encourage my student to procure this. It's basically available at a very affordable rate. Get a copy of this, and you'll be able to get all the solutions for all the assignment which I'll be giving in a class. So therefore, I welcome you in this class of advanced financial reporting. Again, I will be your lecturer for advanced financial reporting and analysis.
Hello learner, welcome to Manifested e-learning platform. My name is FAM Lingwiri and I practice within the financial services industry in Kenya. Today we are discussing on the financial modeling and data analytics paper. The focus is on the December 2023 sitting. We are going to discuss on question 21. The question reads as follows. Eugene Shahira has been provided with a set of historical data by one of his clients, which include a set of assumptions, statement of comprehensive income, statement of financial position, statement of cash flows, and supporting schedules as presented below. And so you can see down here the assumptions. These are the assumptions that have been given to us here, and you can see they're presented in blue for the forecast period, and this is the historical results. We have the income statement, the balance sheet given to us down here, and the cash flow statement just under it. Finally, we have what is called the supporting schedules. We are required using the assumptions presented in the assumptions table, assist Eugene to complete the following statements of forecast period for the forecast period. A, the statement of comprehensive income, the statement of financial position, the statement of cash flows, and the supporting schedules. All of these total to 30 marks. So we go back up and start filling out the income statement based on this forecast period right over here. So the forecast period is from 2017. And we are going to start with the income statement. So the revenue, to model revenue, we have been given the revenue growth rate over here. And so we are saying that we are going to assume that the revenue is going to grow at 5% initially, 4.5%, 4%, 3.5%, and 3% in 2021. So we will increase this 150,772 by a factor initially of 5%, 4.5%, and so on and so forth like that. So let's do that together. So the first thing is to link it with that, and then we multiply by that factor 1 plus now this growth rate right over here, and we close the bracket so that now the model can be complete, or the formula can be complete. You can see in 2017 we expect it to be like that. So we drag it, Control R, and it picks the formula like that. Else we can do the following. If we don't prefer to do it like that, we just focus it like that, and we wait for that plus sign over here like so, and then we drag it like that. So we drag the formulas, and you'll still see the answers are the same. How do we model cost of goods sold? Now we are told that the cost of goods sold is provided as a percentage of revenue. Meaning what? We get the cost of goods sold over revenue gives us 37.5%. I can do it right above, right beside it here. So you can say COGS over revenue will give us the COGS percent, which is this one right here. But how then can we use the COGS percent to be able to model the cost of goods sold? We just get the revenue and multiply it with the cost of goods sold percent, so that now we can be able to model the cost of goods sold, because that is what we're going to remain with over here. Because cost of goods sold over revenue is cost of goods sold percent. So we cross multiply the revenue multiplied by the cost of goods sold percent, then we should be able to have the COGS. And that's what exactly we're supposed to do. We take that and we multiply, or the revenue, we multiply that with what is called the cost of goods sold percent as a percentage of revenue. Enter there. And like the same way we've done before, we just drag it, Control R. The gross profit, because it's a formula, we just drag it, Control R. Now we move on to the expenses down here. So the salaries and benefits, what are we told as far as the assumptions are concerned? We are told that the salaries and benefits are given to us in terms of shillings, 25,000 all through like that. And here we're saying it's going to remain as 10,000 in terms of the depreciation component. So because they're following each other like that, and these are considered to be fixed costs, we just pick them from above. There, just pick it up from there. And also because they're following each other, just drag it like that, put it like that. And then now, fill it out like that. What I've just done, I've just picked this one from here. And you can see from here, this is I32. Like that. So it's I32, which is this cell over here. But now, where do we pick it from? We pick it from I13. This is I13. I13 is this one here. So we're picking it just from there. And then also this one is going to be I14, which is down there. Now we move ahead and try and model the depreciation and amortization. In real life, trying to model depreciation and amortization will prove to be a bit of a challenge. Determining will be a bit of a challenge because we need to know whether it's going to be reducing balance or whether we're going to use straight line method. For simplicity's sake, the way I've seen it right over here, depreciation as a percentage of PPE, it's just based on straight line method like that, for simplicity's sake. So the depreciation and amortization is driven by percentage of opening balance of PPE. So we will initially leave it over here because we do not have the values of PPE given to us directly. And we'll model it a little later on. As well, the interest right here. The interest right over here is based on opening balance. We do not have the opening debt balance given to us here. So what do? We first of all leave those two alone like that, and we will be able to try and model them a little later on. So we put maybe say a faint color there on them, like so, to show that we're going to come back to it a little later on. Because these are totals, the ones in black are always totals, the ones in blue are hard-coded values. We just drag them. That. Remember that this value here is bound to change as well as this value is bound to change because of we've not filled out the depreciation, neither have we filled out the interest. Now the taxes over here, we have been told something about the tax rate right above here. You can see the tax rate is as a percentage of earnings before tax, and you can see it's 28% all through. So what does that mean? That this tax rate will be based on that value times the taxation rate which is given to us right here. So we link it with that one there. And because this is also going to change based on these values given to us there, we just drag it, and because Excel is very wonderful, it's a very wonderful tool, it will just pick everything, or it will pick the formulas based on the values that are inserted right at this point here. This is a formula, so we just drag it like that, moving towards the right. So we have partially filled in the income statement with the exception of depreciation and interest expense. We move over to the balance sheet and try and model it and see if you can be able to model some items. Cash will be the very final part that you're going to fill out, and it will be like what is called the balancing figure as we approach the end of the model itself. How do we model accounts receivable? the accounts receivable, if we can go back to the assumptions section over here, this is the assumption section right above here, you can see we've been given accounts receivable days. We've been given 18. And accounts receivable days is driven by revenue. So it is accounts receivable over revenue times 365. We can get this from these black formulas over here. So if you double click, you can see it is the revenue, or it is rather the accounts receivable. Yes, if you said before, accounts receivable. We divide that with the revenue, and then we multiply by 365 to enable us get the days. Now that we've assumed that the days are going to be 18 over here for the forecast period, and you can see this is the forecast period here, 2017, how do we model the accounts receivable here? We are going to move ahead and say that it is accounts receivable, like that, is given as how we're going to model it over here. We'll pick the revenue, because we've said that we already have the accounts receivable days, and then we divide that, or rather, let me just tell you what you're going to do, because the formula is given to us right over here. You can see this is it over here. We are saying we're going to get the revenue, or rather the accounts receivable over the revenue times 365. So we're just going to do this. We are going to pick the days over here, accounts receivable days. So accounts receivable is going to be given as the days, and then we multiply that with the revenue, and we divide this, all of this, by 365. By 365. Over here, 365. That. So days times revenue over 365. We've just adjusted the days. Initially, for us to get the days, we're saying we get the accounts receivable times 365 over revenue. Just rearranging this formula. And that's exactly what we're going to do over here. We get the days. The days are here. See where they are. Just a second. Accounts receivable days. There. And then we multiply that with the revenue. Then we divide over 365. And we have that value given to us there. So Shift, Control R, we model that. Inventory is driven by cost of goods sold. So in a similar fashion over here, the formulas, the formula here, we'll get inventory is given as, or given by, the inventory days times COGS, not times revenue, and here we're dividing against 365. That. So that's what we expect over 365. So that's what we are going to do. We pick the cost of goods sold there, just to double check, cost of goods sold times the days. Which days? The inventory days right here, 73, divide by 365. Once we divide that by 365, then we should be able to get the 11,715. We drag it. PPE, or property, plant and equipment. Remember, this is the one that is going to drive our depreciation component over here. But since we don't have it yet over here, we leave it out for now. The second time coming down, we will be able to fill it out. Because this is a formula, so Shift, Control R. we can proceed on to the liabilities. Obviously, these values are bound to change because we've not filled out the cash, neither have we filled out the PPE. So the accounts payable is driven by cost of goods sold. The same formula over here, only that we're going to put now accounts payable. Now over here, payable. Payable for revenue 365. So we look for the accounts payable days. Accounts payable days, you can see the accounts payable days are here, 37. And then we multiply that with the cost of goods sold and then divide by 365. That's what we get. The debt, we will be able to fill out the debt and link it with the debt component from the supporting schedules. So here we drag it like that because this is a formula here, it's just the total. So this one I'll put it in a different color so that for consistency's sake to maintain to show that this is the part you're going to come to later on and fill it out. In terms of the equity capital, we are going to link it. So we're going to drive it previous equity capital, then we add any new issuance and repayment of equity. So we come back up over here to the assumption section, this assumption section. Was there any issuance and repayment of equity from 2017? There is what we link it with over here. And we enter. The retained earnings is driven by the previous retained earnings plus the net earnings for the current year, which is this one here. Remember, this value is going to change because of these two, depreciation and interest. Enter. We drag them towards the right. And this one remains like so. So shift, control R. So it picks the formulas as the way they are. Remember, in a balance sheet, we always have a check. This check, with your permission, it will obviously not balance because we are saying that here we have got some missing items. You can see it's not balancing at all. But it's up to our responsibility, based on what the examiners asked us, to fill and ensure that this one balances off, the balance sheet balances off based on the forecast. Now, as far as the cash flow statement is concerned, we will first of all ignore it for now. We ignore the cash flow statement and we will be able to also do a check for the cash flow statement and write down over here to determine if we're actually cooking figures or not. We jump onto the supporting schedules. These supporting schedules are broken down into three: the working capital schedule, the depreciation schedule, and the debt and interest schedule. These schedules, these three of them, are instrumental towards filling in the missing items in the balance sheet, income statement, and the cash flow statement. So from here, the accounts receivable. You remember we had modeled it just above there in the balance sheet. So we just fill it out, link it with the one accounts receivable here. And you can see the accounts receivable is here, so we link it right over there and we put enter. Because they are following each other with the inventory, I can just drag this sort of down like that and it picks from above. The accounts payable, we also had filled it out or computed it above from the balance sheet here. The accounts payable, as you can see right over here, is 5938. You see it's okay. Link it like so. Then these are black. It means that they are formulae. To get the net working capital, we get the accounts receivable, we add the inventory, and then we less the accounts payable. That's how we get the net, the change, the net working capital component. So Just put it like that, and it picks. The change in net working capital is the difference between changes in this year from last year's. You can see the formula there. This value subtracting that value there. So I'll initially fill it like that, then now I can drag it moving down like that, Shift Control R. So once we have those values given to us there, we are saying that now the working capital schedule is complete. The change in net working capital is going to be useful in computing some items in the balance sheet or in the in the cash flow statement, pardon me. So we move down to the next supporting schedule, depreciation schedule. Now we can see something that is very unique from the historical values here. This value, which is the opening PPE, is there picked from the closing value here. This value has been picked from the closing value here. This one has been picked from there. So it goes without saying that this value here will be picked from the value there. How much is our capex? Our capital expenditure is representative of how much money we are going to spend out within the year. Outflow of cash, maybe to invest in new machines, new equipment, so forth. And we will link this with the supporting schedule up from, rather not the supporting schedule, the assumptions section. This one here. And we are saying that the capex, capital expenditures over here, is given to us there. So we link it with that and we press enter. The depreciation is based on the opening PPE always. So pick the opening value of PPE and multiply that with the depreciation rate. Remember, we are saying that we are assuming it for simplicity's sake is going to be straight line method. So depreciation, and we are saying we are going to multiply it with that. And we get that. To get the closing PPE, we are saying we are going to get the opening PPE, we add the capex and less the depreciation on the machines. So we drag the formula moving to the right like that, and we can sort of pull the formula towards the right or drag it. Now the final supporting schedule is the debt and interest schedule here. How do we model it? The debt opening, just like the way we are done in the opening in the depreciation schedule, this value is that value, that value is that value. So it goes without saying this value is going to be that value. So pick it from there. And the issuance and repayment of debt can be gotten from the assumptions section, which is up above over here. So debt and issuance repayment right now here, you link it with that. So here, because it's a formula, we just drag it. So we drag it over here, it's like that. We wait for the plus sign that looks black like that, which is over here like this, and then we sort of drag it. We just drag it moving towards the right. How do you get the interest expense? The interest expense is based on the opening value times interest on the assumptions section. Interest as a percentage of opening balance here is 3%. Now our schedule, or our supporting schedule rather, is complete. That's what we're saying we're going to do. We drag it. These values over here are going to be instrumental towards filling out the cash flow statement. But first, let's go back up and start all over again from the income statement here and fill out what is missing. We have the depreciation component, so we link it with the ones in the supporting schedule. So we go down on here. here, and you can see the depreciation is given to us over here. There, enter. The interest expense right here, interest expense is linked to the supporting schedule here, right here, enter. Then we can be able to just drag it towards the right there, Control R. And in a good account or analyst format, we just make sure that this part is the same color because we've already filled out the missing items and our income statement is complete. Now, like I said before, that the cash is going to be filled out at the last, at the tail end. It's like the balancing figure. We can fill out the property, plant and equipment. So, we're saying it's going to be from the supporting schedules down. So, we are saying it's going to be this value here, the closing. You're reporting at the end of the financial year. So, we pick the closing balance there and we drag it towards the right. Remember, it's just the sum of all of them. As well, the debt, we pick the closing debt, which is right here. Closing debt should be that. We can just drag it, Control R. So we can then, of course, now remove the theme color, put it here like so, with the exception of the cash. Now let's fill out the cash flow statement. Net earnings is picked up from above here. Here 35 is here, the net earnings, you can see the net earnings is there. Here we have the depreciation and amortization over here. Right here, so we pick that. And then we are saying changes in working capital. Where do we pick it from? We pick it from the supporting schedules, right here. Change in net working capital, and we are saying we are going to pick that value. So because this is black and it's a formula, I can just drag it like so. Now we are almost there, but we are not there quite there yet. The investments in PPE represent the capital expenditures. So the capital expenditures down here, capex, you can see the capex is here. Link it to that. And this one, sort of pull it towards the right, and it's complete. As far as the financing cash flow is concerned here, issuance and repayment of debt, we link it with the supporting schedules, rather with the assumptions tab, sorry, up, debt, here. And remember, they are following each other with equity. So, like that. And this can be dragged like so because it's a formula, and we can complete this by doing that, by dragging the formulas moving to the right. The net increase or decrease in cash is a formula because you can see it right above over here. We're going to add cash from operations. We subtract cash from investing because that's money going out, and then we add cash from financing so that we can be able to get the decrease or increase in cash. Drag that towards the right. And we're saying that we can then pick the opening cash balance. Remember, this opening cash balance is the closing cash balance here. This one is that one, and that one is that one. So we are saying that we can then link that with that value. This one is a formula like so. So we can then drag these values moving towards the right, and we have the values like so. Now to try and test and see whether this is actually going to balance, because we are through, answered the statement of comprehensive income, statement of financial position, statement of cash flows, and the supporting schedules, we can see that it's still not balancing. Remember one thing, what I had mentioned, that the cash balance is the one that is the balancing figure right here. So let's try and see if you're going to link it, if it's going to balance. So we link this cash value with the closing cash balance right here, this one here, and you can see it has balanced. But dragging the rest towards the right is the one that's going to tell us whether we are on the right path. And you can see it has balanced very well. The cash flow statement has also balanced as well, meaning that we have successfully answered the question presented to us by Kasneb. We hope that you've enjoyed this session of ours, but before we part, there is one thing that I want to try and see and to ask you, whether even if we change these assumptions here, whether it will still balance. It will still balance. That may be the question. So even if I put this to 25 million like that and leaving the rest the way they are, look at the balance sheet. It still balances. If I put this to maybe 50%, that it still balances. So this issue or this idea of cooking figures cannot arise because Excel is truthful, and being a true financial analyst means that you need to know how to model all of the three statements: the income statement, the balance sheet, statement of cash flows, very well. Thank you for being with Manifested Publishers, and God bless you.
Hi candidates, welcome to another session of Manifested online classes. So in this session, I want us we continue with the topic on impairment of asset. So in our previous class, we discussed or we defined what is an impairment, when an asset is deemed to be impaired, those particular factors which shows that the asset could be impaired. And also we did an illustration question as far as the determination of impairment loss is concerned. So in this session, I want us to look on what is a cash generating unit in accordance with IS 36, and how do we determine the impairment loss of a cash generating unit, and how is such impairment loss allocated to those particular assets within a cash generating asset. So first of all, we'll talk about cash generating unit, which is abbreviated as CGU. This refers to a group of assets which generate cash flow as a group. Basically what that means is that if you pick one of the assets from that particular group of assets, that asset cannot be able to generate cash flow on its own. A good example is something like a factory. So a factory, we know, do have a number of assets. We have the factory building. We have the machines which are installed within the factory. We also have computers maybe for record keeping. We also have some tractors which work in the factory for transporting the raw materials maybe from point A to point B and so on. So therefore, a factory is basically a cash generating unit. It's basically a group of assets which generate cash flow as what? As a group. What that means, therefore, is that if you pick one of the assets from that particular group, it cannot be able to generate cash flow on its what? on its own. As we are going to see later on, in determining now the impairment loss of a cash generating unit, we determine the impairment loss of the entire group of assets and not the impairment loss of the asset within what? Within that particular CGU. But before we do that, let's first of all define what is a cash generating unit or a CGU. And I've said that this is a smallest identifiable group of assets, assets that generate cash flows, that are largely independent from cash flows generated by other assets, or group of assets, So that is the definition of a cash generating unit. Now, what you have said is that when it comes to determining the impairment loss of this particular cash generating unit, we have said that we determine the impairment loss of the cash generating asset, not the impairment loss of individual asset within what? Such a group of asset, simply because you have said that this particular asset here, they generate cash flow as a group. And it is also important for you to recall, for you to be able to determine the impairment loss of an asset, there is something you need to determine or to compute known as the value in use. We compute the value in use or the recoverable amount of an asset using the cash flows which are generated by the asset. And due to the fact that individual assets do not generate cash flow on their own, it is not therefore possible to do what? To determine the impairment loss of individual asset within that group. But what you're saying, we determine the impairment loss of what? Of the entire cash generating asset. So therefore we can say that it is not possible to determine a recoverable amount of individual assets, within the cash generating unit. I've explained the reason why this is the case. We are saying if, for example, we have a group of assets, we can take, for example, a factory. Factory, we have said, comprises of a number of assets. We have the machines in that factory. We also have things like the patent. The patent is that innovation used by the company in terms of producing various products. We also have things like computer equipment. We also have things like what? Motor vehicles, which work within that factory and so on. So therefore, we are saying that this is a good example of what? A cash generating unit. So this particular asset here generate cash flow as a group, meaning that if, for example, you pick one asset from this particular group, like maybe you pick something like machines, these machines cannot be able to generate cash flow on their own. And therefore, it is not possible to determine the recoverable amount of that particular what? Machine. Because for you to determine the recoverable amount of the machine, there is something which you need, and that is the cash flows generated by that machine. We are saying the machine itself cannot or do not generate cash flow on its own. The cash flow which is generated, it is generated by all these particular assets as what? As a group. That's why we are saying it is not possible to determine what? The recoverable amount of individual asset within what? The cash generating what? Unit. So instead now what we do, we determine the recoverable amount of the cash generating unit, and further we go ahead and determine the impairment loss equally of the cash generating what? Unit. So therefore we can say thus the recoverable amount recoverable amount of the CGU is determined, which is then used in computing impairment loss, of the cash generating what? Unit. So therefore, once we have a group of assets which generate cash flow as a group, we are saying it is not possible for you to determine the impairment loss of individual asset here, but what you do, you determine the impairment loss of the group of assets. You determine the impairment loss of the cash generating unit. Now, once the impairment loss of this cash generating unit has been determined, and actually this impairment loss of a cash generating unit is determined in the same way, just like how we determine the impairment loss of individual asset. Maybe you can just remind ourselves about on how we compute the impairment loss. So the impairment loss is equal to the carrying amount minus the recoverable amount. The recoverable amount, and equally you have to recall that the recoverable amount here, we said this is the higher of two values. Number one, the value in use, or number two, the net realizable value or fair value less cost to sell. So therefore, in terms of how we determine the impairment loss of cash generating unit, we use the same approach, the same formula for determining the impairment loss for individual asset. Now, this particular impairment loss for the cash generating unit, then we are saying should be allocated to the asset within that particular cash generating unit. And in doing that particular allocation, in allocating the impairment loss, there is the order which is followed. So therefore, you can say the impairment loss for the CGU cash generating unit is allocated to the assets within the CGU in the following order. So number one, we allocate to those particular assets which are obviously impaired. Number one, to assets obviously impaired. Assets obviously impaired. And when talk about assets which are obviously impaired, these are assets which are damaged, or the assets which are destroyed, the assets which are destroyed. So basically what that means is that if the company decide to sell this particular cash generating unit, then that particular asset which is obviously impaired will not fetch any amount of money because it is damaged, or basically it is what? Destroyed. Number two, we allocate impairment loss to the goodwill, in the cash generating unit or in the CGU. And number three, we allocate to other assets. To other assets on pro rata basis, i.e. based on the carrying amount, or the net book value. So any impairment loss now will be allocated to the other asset other than goodwill, other than those particular assets which are obviously impaired, and that should be done in accordance with the net book value. In this case, we have said to other asset on pro rata basis. It is also important here to know that when allocating this particular impairment loss, the value of the asset should not be reduced below the higher of the three values. Below the higher of three what? Values. So therefore, we can say in allocating the impairment loss, the value of an asset should not be reduced below the higher of three values. Number one, 0. Number two, the net realizable value of the asset. And number three, the value in use if it is determinable. If it is what? Determinable. Remember, in this case, in determining the value in use of an asset, we use the cash flows. We discount the cash flows to be generated by such an asset. But we are saying assets which are within a CGU, asset which generate cash flow as a group, then it is not possible to determine the cash flow generated by individual assets, because those are assets. They are generate cash flow as what? As a group. So individual asset cannot be able to generate cash flow on its own. And therefore, in most of the cases, it is not possible to determine its value in use. So therefore, once you have allocated the impairment loss, then make sure that the value of the asset is not reducing below the higher of 0, net realizable value, or the value in use. So therefore, that is what is important for you to know. You need to know what is a cash generating unit. How do we determine the impairment loss of the cash generating unit? And equally, how do we allocate that particular impairment loss to those particular assets within the cash generating unit? And basically, I've said that is the order which is followed. To the asset which have obviously impaired, to the goodwill, and basically to the other asset in that cash generating unit on a pro rata basis. So I want us to do an illustration as far as this is concerned, and the illustration question I want us to do is a question which was tested in the sitting of August of 2022, and then at the end of this lesson, I will give some assignment on the same. So let's look on that question. So this is a question for August of 2022. Question number 2A. So the question is, B Limited operate a factory as its sole cash generating unit. During the year which ended 30th of April 2022, there was an explosion in the factory which necessitated an impairment review. So basically what that means that at the end of the year 2022, there was some evidence which showed that this cash generating unit could be impaired, and therefore there was a need to carry out impairment review. So we are given the carrying amount of the factory asset, which were as follows. So we have goodwill, and the carrying amount was 2 million, patent 3.6 million, machine 4 million, computer equipment 8 million, premises 30 million. The total carrying amount is 47.6 million. Then we have some additional information. Number one, we are told an impairment review or an impairment review revealed a net selling price of shillings 19.2 million and a value in use of 31.2 for the factory. 2, half of the machine have been destroyed and have no resale value. Number 3, the patent have been superseded and are now considered valueless. And number 4, we are told the company follow the cost model as permitted by International Accounting Standard number 16. that is which deals with the PPE. So what that means that the property, plant and equipment which are owned by this company, they are accounted for using the cost model. Remember what you have said is that if the company is accounting for its assets using the cost model, then the full amount of impairment loss should be deducted from the value of the asset. Should be deducted from the value of the asset. That is the implication, or basically the importance of that particular point. So what you're required is to discuss with suitable calculations how any impairment loss in the cash generating unit CGU would be accounted for in accordance with what? International Accounting Standard number 36. So we are required to discuss with suitable calculations. So basically what you needed to say here is that this company, that is B Limited, will need to carry out impairment review, or basically we need to determine the impairment loss of this cash generating unit and then proceed to allocate it to the asset within that particular cash generating unit. And actually we have discussed on the order to be followed by the company in allocating that particular impairment loss. So therefore, before we can determine the impairment loss, we can say that on 30th of April 2022, which is now the end of the year, B Limited must do what? Must carry out impairment review and any impairment loss should be allocated to the asset within the CGU, within the cash generating unit, in the following order. One, we have said impairment loss should be allocated to assets which are obviously impaired. Number two, we allocate to the goodwill within that cash generating unit. And finally, to other assets on pro rata basis. On pro rata basis means that when allocating now the impairment loss to the other asset within the CGU, we allocate that particular impairment loss based on the net book value of the other assets. The net book value, remember, is the same with what? The carrying amount. That's the first thing you needed to say. And then from there, you proceed, you determine the impairment loss. For you to do that, you must have the formula of determining the impairment loss, which is the carrying amount minus recoverable amount. So we need to have these two values, carrying amount and the recoverable amount of the cash generating unit. So the carrying amount, remember, is the same with the net book value, because the examiner may give you the net book value instead of the carrying amount. And we already given that amount under paragraph 2 of this cash generating unit, which is given as 47,600 million. So that figure is already given. Then we have that we need next to determine the recoverable amount. And the recoverable amount, we have said that this is taken to be the higher, or we take this to be the higher of two values. Number one, the value in use, of which the value in use is given in the additional information number 1. We are told the value in use was 200 million. 200 million shillings, 200 million. So we take that all Roman 2, the net realizable value. The net realizable value in other terms is the fair value less cost to sell, and this is what in the additional information number 1 is given as the net selling price. The net selling what price? Because when talk about the net selling price, this is the amount now which the company will receive after selling the asset minus any cost which will be incurred by the company in selling that what asset, and this is given as 19,200 million. 19,200 million. So what we need to do, out of the two figures, we need to take the figure which is higher. Automatically, that will be that 1.2 million, and that will be the recoverable amount. So therefore, you can say our recoverable amount, is shillings 31,200 million. 200 million. So having this value here, having the recoverable amount and the carrying amount, so what we need to do is to determine whether our cash generating unit is impaired. Remember, generally we have said an asset or even a cash generating unit will be deemed to be impaired when the recoverable amount is less than the carrying amount. So in our case, we know the recoverable amount is 31,200 million. What about the carrying amount? It is 47,600 million. So we need to check, is our recoverable amount less? Is this less than that one? Yes, it is. If that is the case, then we say that our asset here is what? Is impaired. Not the asset, rather, our cash generating unit is what? Is impaired. And therefore, what we need to do, we need to proceed and we determine the impairment loss. The impairment loss, we use our formula up here. We take the carrying amount, which is 47,600 million, minus the recoverable amount, which we already have here, 31,200 million. So we get the difference here, which now will be what? Which will be the impairment loss. So we have 47,600 minus 31,200. Okay, we can take that again. 47,600 minus 31,200. So that will give us impairment loss of shillings 16,400 million. 400 million. So what we need to do now is to proceed and allocate this impairment loss to the asset within that particular cash generating unit. So we need to do the allocation of that impairment loss. So we have allocation of impairment loss. Allocation of impairment loss. So remember what we said is that in allocating this particular impairment loss, this is the order which we follow. 1, we allocate to those assets which are obviously impaired. Then we allocate to the goodwill. And finally, we allocate to the other asset based on their carrying amount. So there is some information which you are given in this particular question here. Let's go to the additional information number 2. We are told half of the machine have been destroyed and therefore they have no resale value. So any asset which do not have a resale value, such asset is obviously impaired. Because you have said assets which are obviously impaired are those assets which are destroyed, or basically those assets which are fully damaged. So therefore, number 1, we are going to allocate to machine. And basically not all the machine. We are told half of the machine. Half of the machine. And if you go back to the information we have under paragraph 2, the machine have a carrying amount of 4 million. 4 million. it is important to note that these figures here are in thousands of shillings. These figures are in thousands of shillings. So therefore, these will not necessarily be millions. Yes, because our figures are in thousands of shillings. Yes, so let's do away with the million here. Let's do away with the million here. Yes, but we need to know all our figures here are in thousands of what? In thousands of shillings. Yes. So first of all, you're going to allocate to the machines, not all the machines, but half. So machines, they have a value of 4 million. So what is half of 4 million? Half of 4 million is 2 million. So therefore, because those machines are fully impaired, we are going to allocate an impairment loss equivalent to their carrying amount, which is 2 million, such that once you have allocated that impairment loss of 2 million, we are going to reduce the carrying amount of 2 million with 2 million. And that means that the value of those machines after allocating the impairment loss will be zero. Will be what? Zero. So basically, it means that the other machines, and that is half of the other machines, or half of 4 million, those machines are not obviously impaired. So then there is also another information we have in note number 3, that patent, which is one of the assets within that CGU, have been superseded and are now considered valueless. So when talk about patent, a patent is basically an innovation which is used in the factory in terms of producing various products. So if you're told it is superseded, it means that it has been replaced by a new patent, and therefore it is considered to be valueless, meaning that such asset is also considered to be fully what? Impaired. So if the company decides to sell this CGU, that patent will not fetch any amount of money. So therefore, next we allocate to the other asset which is obviously impaired, and that is what? Patent. And in this case, we are going to allocate impairment loss of how much? That is 6. Remember, our total impairment loss is 16.4. So therefore, in allocating this impairment loss, always you must remember how much is the impairment loss. You can see to this machine, we have allocated impairment loss of 2 million. So meaning that out of the total impairment loss, we have an impairment loss which is remaining of 14.4. So we then allocate now an impairment loss to patent of how much? That is 6. Still, our impairment loss is remaining. Then we have allocated out to the assets which are obviously impaired. So these are assets obviously impaired. So next, we allocate now to the goodwill. Within that cash generating asset. So the value of goodwill is what? Is 2 million. Can we be able to allocate a full amount of 2 million? Yes, because remember our impairment loss 16.4. To the machine, we have allocated 2 million. To the patent, we have allocated what? That is 6. So mean that the remaining impairment loss is in excess of 10 million. So therefore, to the goodwill, we are going to allocate the full amount of what? 2 million. Yes, so that is goodwill. And then finally, we allocate now to the other asset within that CGU. So which are those other assets? We can just list them here. Other assets. These include, from the list which you have provided under paragraph 2, we have allocated to the goodwill, we have allocated impairment loss to the patent, and then we have now the machine. We can talk of the other machines. Remember, the machines which were fully impaired here were half. So the other machines will be having a net book value of what? A net book value of 2 million, or a carrying amount of 2 million. So and then below that we have computer equipment. We have not allocated any impairment loss to those computer equipment. The net book value or carrying amount is what? Is 8. And then we have a premises. Whose value is 30. So mean that the total carrying amount of these 3 assets is what? Is 40. So why do we need this particular value here? We need that particular value because we are going to allocate now the remaining impairment loss to those 3 assets based on their carrying what? Based on their carrying amount. So therefore, what we need to do, we need to determine the impairment loss now to be allocated to these 3 assets. So how do we determine that? So the first thing we need to do is to determine how much impairment loss was allocated to machine or the total impairment loss allocated to this machine which were destroyed, patent and what, and goodwill, and this will give us 4 million, meaning that that will come to a total of 36 plus 4,000. That will come to a total of what? Of 76. So mean that the total impairment loss which is yet to be allocated will be equal to the total impairment loss minus the impairment loss which has been allocated to these 3 assets, 76, and the remaining impairment loss will be what? Will be 800. So, or 8.8. So this impairment loss will be allocated to these 3 assets based on their net book value, based on their carrying amount. So to determine the amount to be allocated to other machines, we take its carrying amount, which is 2 million, all over the total impairment, all over the total carrying amount of the 3 assets, which is 40 million, times the impairment loss to be allocated to the 3 assets. We do the same for computer equipment, 8 million, all over the total impairment, all over the total carrying amount, 40 million, times 800, and finally to premises, 30 million, all over 40 million, times 800. So this will give us the impairment loss to be allocated to those 3 assets. So to the other machine, we have 2 out of 40 times 800, and that will give us for 40. Remember also these figures are in thousands of shillings. What about to computer equipment? We have 8 all over 40 times 88, and that will give us 1760. And then finally to what? To premises, 30 divided by 40 times 800. So which will give us 66. So that is now the impairment loss to be allocated to other machines, computer equipment, and the premises. So that is it. That basically what was required as far as that particular question was concerned. And basically by determining this particular impairment loss and then proceeding to allocate it now to these other assets, then by doing that, you could have gotten now the allocated 10 what? 10 marks. So that brings us now to the end of that particular topic regarding the determination of impairment loss in accordance with the International Accounting Standard number 36. But before we end our class, I want to give some assignment. These are some questions from the past papers. Make sure you attempt those questions. We have 2 other questions on this. So the first question is for September 2021, question 5B. So this question was requiring the computation of impairment loss for 2 cash generating units. And then we have another question for December 2023, which is question number 1C. Question number 1C. So make sure you attempt those 2 questions. 2 questions. And equally, if you have a challenge in terms of answering those questions, I always usually encourage my students to acquire this revision partner. All those particular questions are here. The questions are here, and also the solutions for those particular questions are at the end of this particular book. So if you have a challenge in terms of answering those particular questions, make sure you get this revision partner, which is basically available at a very affordable rate. So therefore, we come to an end, or basically that is the end of that particular session. So see you in the next class as we look on the other subtopic. Relevance.
Relevance. How relevant is this concept? How relevant is the concept of time value of money? The ball is in your court once again. Investment decisions. Someone said investment decisions. Investment decisions. Investment decisions. Investment decisions or capital budgeting decisions. When evaluating investment opportunities, candidates, the time value of money allows us to compare the value of future cash flows generated by an investment to the initial cost. And that is done through techniques like discounting, which in this lesson we are going to look at that. In this lesson, we'll move into discounting techniques. We'll be seeing how that plays out in real life. So capital budgeting is one area, or investment, all right, when evaluating investment opportunities. The time value of money allows us to compare the value of money, that is comparing one project, do you understand, with the initial cost, so that you can find out if the project is viable or not. Investing decisions. What other point we have? 2, capital budgeting. Capital budgeting. Businesses use the time value of money to assess the profitability of long-term projects, and by discounting the future cash flows back to their present value, they can make informed decisions about which projects to undertake. Capital budgeting. This concept is also applied in financing decisions. Financing decisions. Whether choosing between debt or equity financing, or evaluating different loan options, understanding the time value of money is essential because it helps in assessing the true cost of borrowing and also comparing different financing alternatives. Relevance. Valuation. Valuation. Determining the fair value of businesses or assets, determining the value of bonds, determining the value of stocks. This concept is relevant in doing that. All right? It allows for a more accurate assessment of what an entity is truly worth. It could be the whole entity, or it could be the value of assets like the financial instruments, and so on. Valuation of bonds, valuation of equities, valuation of businesses. Do you understand? Valuation. This concept is also relevant in personal finance. Personal finance. Personal finance. Now, the time value of money is also crucial for individuals, because understanding this concept helps in planning for retirement. It may also help in making individual investment decisions, okay, savings decisions, and even just evaluating the terms of things like a mortgage and so on. Personal finance is one area in which time value of money is also relevant. And you can see, candidate, these are just some of the topics that we'll be covering. It's a topic on financing, capital budgeting, valuation, personal finance. That's why this topic is very key in understanding the other topics. This is the bedrock of finance, candidates. It's like the foundation upon which most of the other topics are laid. So when you hear candidates complaining that an exam was tough, it was difficult, One of the major reasons is failure to properly grasp the concept of value of money and knowing how to discount cash flows, to compound cash flows, to compound annuities, to discount annuities, and so on. So if you've been having challenges in this paper, one area in which you need to revisit is the time value of money. And that is what we are doing now. Do you understand? So the time value of money, candidates, I repeat, recognizes that a shilling today is worth more than a shilling in future due to its earning potential. And the principle underlie many financial calculations and decisions, which makes it the cornerstone of a sound financial management.
Now, what are some of the methods of data collection? So data collection is a crucial step in any research or analysis. And we are going now to look at some of the common methods that may be used to gather data. So number one, surveys and questionnaires. So surveys and questionnaires are structured. They are predetermined questions with fixed response options. They could be unstructured, where there are open-ended questions that allow for more detailed responses. There could be online surveys, which are efficient and cost-effective, but may have lower response rates. Paper-based surveys, these can reach a wider audience, but may be time-consuming to collect and analyze. So surveys and questionnaires, they could be structured, unstructured, online surveys, paper-based surveys, and nowadays you could have the online ones also taking some kind of a blend in terms of Google Forms, which can be used with mobile phones. Number two, interviews. So interviews could be structured, unstructured, in-depth, or focus groups. So structured, you could have predetermined questions with fixed response options. Unstructured, open-ended questions that allow for more detailed responses. In-depth interviews could be detailed explorations of a specific topic. Focus groups could include or have interviews conducted with a small group of people to gather diverse perspectives. Now, when it comes to observation, that is the third method for collecting data. You may have participant observation. This is where a researcher actively participates in the observed setting. Non-participant observation, where the researcher observes from a distance. Structured observation, where a predetermined checklist or coding system is used. And structured observation, these are observations that are made without a specific plan. You just walk in, look around, do this and so on, then be able to observe. So that's the third method of data collection. The fourth method of data collection could be experiments. So experiments could be controlled or natural experiments. So under controlled experiments, the researcher can manipulate one or more variables to measure the effect on a dependent variable. So that is dependent variable. Or it could occur in the natural experiments, observe the effects of naturally occurring events or changes, like if it is a social phenomena. Or you may have number 5, document analysis. It's a method also of data collection. So here, existing documents are reviewed, for example, reports, memos, or letters. Content analysis could also be done where systematic analysis of text or other content is undertaken under document analysis. Then 6, nowadays in the electronic age, there are also electronic data collection methods. This is where you could use the sensors to collect data from physical environments, for example, temperature, humidity. Then you have social media mentoring, where you can track online conversations and trends. You could also have what you call web scraping. This is where data is extracted from websites. 7, administrative data. So this could be government records, census data, vital statistics, company records, sales data, customer information, healthcare records. You could have patient data. Number 7, secondary data. So this is data collected by others, government agencies, research institutions, or private organizations. So these are 8 examples of methods of collecting data, starting from surveys. Number 1, surveys and questionnaires. Number 2, interviews. Number 3, observations. Number 4, experiments. Number 5, document analysis. Number 6, electronic data collection. Number 7, administrative data. Number 8, secondary data. Now, when it comes to the choice of data collection methods, there could be certain factors that may influence the choice of a data collection methods. And these may include 1, research objectives. So what type of data do you need to answer? What type of data do you need to answer your research question? Number 2, resources. What resources are available for data collection? Number 3, time constraints. How much time do you have to collect data? Number 4, ethical considerations. Are there any ethical concerns to consider? So these are factors that may have a bearing on the kind of data collection method that a researcher may decide to use.
Welcome to our another lesson on Introduction to Microsoft Excel. In our previous lesson, we started on working on how to work with basic formulas and functions in Excel. We looked at the formulas, among them addition, we looked at subtraction, we looked at division, we looked at multiplication, and we also looked at power in cells. So these are the formulas that we looked at last time that we had a lesson. Today, I want us to pick up from where we left and talk about more formulas about the same thing. We are going to talk about average. We are going also to talk about maximum. These are now statistical formulas. We are going to talk about minimum. How do you get the minimum value? We are going to talk about count. We are going to talk about mode. And we are also going to talk about some more formulas here. We are going to talk about standard deviation. Standard deviation, and maybe before I forget, there's also median that is to be done under the statistical formulas on basic formulas in Excel here. So this is what we want to cover, and it will be an extension of the work that you already have. Remember, we had this particular work that we used on our formulas last time. So this one is going to be an extension of what we already covered in our previous lesson. Let us begin by looking at average. So how do you get the average of some marks that you have with you? So average is operated the same way as what we did in the other formulas like addition and also getting the product. So you can average in cell, you can also be able to average in range. Let us start by averaging in cell. Of course, every formula is preceded with an equal sign. Then average, then you double click on average, that will appear there. Then you can click on the cell that you want, or you can type it manually. So in our case, let us click on, we want to get the average of Tom. So I'll click on 65. Then now we separate them with commas. So 65, then comma, 84, then comma, 70, then comma, 76, and if that is the end, you close the bracket, shift and the sign of closing the bracket on the keyboard. After that, you enter, and it will give you the average for Tom for all the units as 73.5. So this is the average, and you can be able to copy it down all the way to the last one, which is not Juliet. I believe there is something wrong there. On our product, in our previous class, I believe we might have included the wrong items. Let me just confirm what we did. Okay, that seems to be okay. It's all fine. So up to the last one, who is Tony. So we've gotten the average of Tom all the way to the average of Tony. I can undo, and I can start again by getting the average. Of course, equal sign, then average. You double click on the average. Then after double clicking on the average, you can type manually like B10, you can see it's highlighted, comma, C10, comma, but that is a long way. If you want to move faster, you just click on them. So 65, comma on the keyboard, 84, comma, 70, comma. Remember, if you want to jump one, you can always jump. Assuming that you never wanted the one for auditing, you can always jump and you click on the last one. So this one is now excluded in your average for that particular period, and you can see the average has reduced. So there's also another way, of course, average in range. So again, average, and you just select average in range. You select up to where you want, up to 76, then shift and you close the bracket. So that is average in range. Then you enter to get 73.5, from which you can be able to drag down your formula all the way to what you want, up to Tony, and you'll get all your averages for that particular student. You can also get average here, if you so wish, average and equal sign, or let us use now the other aspects. You can go to the formula place, AutoSum. If you see average, you click on average. There's average here, but this one will pick everything. You can see up to the next place where there's nothing. So this one majorly picks everything, but you can be able to highlight up to where you want, that is up to Tony, and it will give you everything that you want. If you enter, of course, the average is 66.60. You can undo, and again, in the formulas, you can use the insert function. You click on insert function. What do you want? You want average. Like that. So go, and you will see average highlighted here. Just click on it. Okay. Then you confirm whether B17 to B19 is what you want. B17 is just 15 subtraction, then B19 is just this one. So it's wrong. So it means you can deduct, or you can do away with it and select whatever you want to get the average of. So you just select, you can see it is moving all the way to Tony, and your average is set. So the average is set. Once you have done the correct thing, you click on OK, and you can see the answer is still 66.6. So whichever approach you use, of course, the average is still going to be the same as in any other case. Average, you can see the answer is still 66.6. So you then drag across all the way to MA, so that you can have your average up to MA. So that is the average of those particular items. Having done the average, the next thing is maximum. Now we want to do maximum. What is the maximum? Maximum is the same as highest. So we are looking for the highest value in our set of data under financial accounting. So equal sign, then max. So you look for the function of max. This one returns the largest value in a set of values, and it ignores values and logical values and texts. Of course, this one is max. Then which one is the highest value? The highest value up to there. Then you close the bracket. This one gives you 88. So you can see in this set of data up to here, 88 is the highest value which has been returned by this. So if you copy across, it also gives you the other highest values in, like in this case is 84. In this case, you can see it's 70 is the highest value here. In this case, the highest value can clearly be seen to be 76, of course. So that is highest value using max. What about lowest value? How do you get the lowest value? Of course, when using the lowest value or getting the lowest value, you use mean. So we are going to use mean to be able to get the lowest value. And again, you highlight all the way to this one, and the lowest value there is that one. So the lowest value is 50. The formula is saying that it's 50. Let us see. The lowest value, indeed, 50. Here there is nothing, so it cannot count that. So 50 is the lowest value. There are two 50s, so it will just pick any. What about these other cases? You can drag across and get your lowest value. Again, here they are saying it's 50. Let us confirm. The lowest value is indeed 50 from this set of data. It's 50. What about 34 here? Is the lowest value 34? Indeed, yes. The lowest value is 34 from this set of data. Even here, of course, the lowest value is 24 from this set of data. It is 24. So that is the lowest. If you want to get the lowest value using minimum. Now we want to move to median. How do you get the middle value? Middle value, of course, we'll be using median. Equal sign, then we do median. So you double click on the median and you can be able to get the lowest value in that set of data, median. And that is median. Is it the median? Of course, when getting the median, Excel arranges from the lowest to the largest and then accesses the median value. So if you arrange these items from the lowest to the largest, the median value will be 65. So let us copy across and see which is the median value in the other cases. You can see the median value in these other cases here. So that is median, which helps us to get the middle value or the midpoint. So after the median value, we can also be able to get mode. Mode simply refers to the most occurring. So most occurring, that is mode. Most occurring. So let us see, how do you get the most occurring in mode? So you can see mode, the functions available for this one returns the most frequent occurring or repetitive value in any array or range of data. So this one returns the most occurring. So again, we want to select here and get the most occurring in a set of data. And the most occurring that set of data is 50. Let us see if 50 is most occurring from here to here. Yes, 50 occurs twice. So 50 is the most occurring. If you copy across, you can see that it gives you 50 again here. And indeed, 50 is the most occurring, 50 and 50. But here, the answer is not available. That means there is no most occurring. So there is no most occurring here. There is no figure that is repeating itself in this set of data. So there is no most occurring. Even here, there is no figure that appears more than once. So there is no most occurring in this set of data. So that's why the answer here is not available. And indeed, that is the correct answer, not available. After that, you move to another formula. After most occurring, which is mode, we can be able to get the standard deviation. Standard deviation. Of course, standard deviation is equal sign, then STDEV. That is the formula that you use for standard deviation. What is standard deviation? You can see it says estimates the standard deviation based on the sample. It ignores the logical values and text in the sample. So that we want to get the standard deviation of this set of data from here moving the way to this place. Then you close the bracket and this will give you a B10 to B15. If you enter, it returns the standard deviation as what you can see there. So that is the standard deviation. If you copy across, it gives you the other standard deviations from the other set of data there. So those are the other statistical formulas, basic of course for beginners, that you can be able to use in your work. You can be able to use to manage your work, either if you are a student or if you are working somewhere. These are the functions that are usually used when doing a lot of statistical and also mathematical tasks. There's an Excel file that is attached below the video description, which will use for your assignment. So make sure that you go through it and redo almost everything that you've done, almost everything that we've gone through in this particular lesson. Thank you, and see you in our next lesson.
Hi everyone, and welcome back to the lesson. We will continue with the topic, the financing decision. In our last session, we studied the long-term source of finance known as equity. We gave the characteristics, the benefits, and the drawbacks of equity. We're going to do the same for the second source of finance, which is debt. Long-term source of funds known as debt. And the candidate's debt is a common long-term source of funds for many companies, providing capital that is borrowed with the obligation of repayment over an extended period of time. And today we will first begin by outlining the characteristics of debt. Number one, debt has a fixed obligation. Fixed obligation. What does that mean? That means that debt represents a fixed obligation for the company to repay the borrowed amount, to repay the principal amount, and make periodic interest payments according to the terms of the loan or according to the terms of debt. So if a company decides to rely on debt as a long-term source of funding, then that company will be committing itself to a fixed obligation. Fixed obligation. The company will be obligated to repay the principal amount and periodic interest. Fixed obligation. That is in contrast to equity, where there is no such obligation. Number two, creditor claim. Creditor claim. Now, creditors, who could be banks, a creditor could be financial institutions. These are creditors. These creditors are the lenders. All right? They could be financial institutions or even bond holders or debenture holders. Such creditors have a claim on the company's assets, and in the event of bankruptcy, debt holders are prioritized over the equity holders in the distribution of assets. Those who lend to the company could be banks, could be financial institutions, could be bond holders, could be debenture holders. They have a claim over the assets of the company, and they are given priority over the assets of the company in case of the company's bankruptcy or liquidation. Creditor claim. Number 3, interest. Another characteristic is in relation to the interest costs. interest costs. The cost of debt includes both the periodic interest payments and any associated fees. And candidates' interest costs are tax deductible, which provides a potential tax benefit for the company. Tax deductible. That means before applying the corporation tax on the company's profit, interest has to be deducted. Interest is an expense that is deducted from the gross profit of the company before applying the tax rate. That's a characteristic of debt. It is tax deductible. Maturity debt. Maturity debt. Debt comes with a maturity debt. Debt, this one, comes with a maturity debt. This debt. Debt comes with a maturity debt. Debt comes with a maturity debt, specifying when the principal amount must be repaid. And that distinguishes debt from equity, which represents a more permanent source of fund or capital. Equity is more permanent. There is no maturity debt where equity has to be repaid. But in case of a debt capital, the debt has to be repaid. There is a maturity debt. There is a debt when the principal amount must be repaid. That's a characteristic of debt. 5, leverage. Debt allows companies to leverage their operations by using borrowed funds to finance projects or investments. And while leverage can amplify returns, it also increases financial risk. The company can use debt to leverage, okay, to amplify the returns. And while leverage can amplify the returns of a company, it also may increase the financial risk. 6, collateral requirements. Collateral requirements. These are, collateral refers to security. Some forms of debt may require the company to provide collateral or security such as assets, property, as security for the loan. That is not the case when it comes to equity capital. Some forms of debt may require the company to provide security, like property, land, and so on. Collateral requirements. So these are 6 characteristics of debt. Let's now study the pros of debt. Pros of debt. The advantages of using debt. One obvious advantage is interest deductibility. Interest payments on debt are tax deductible, providing a potential tax advantage for the company. And that can enhance the overall cost of cost effectiveness of debt financing. Interest deductibility. That means that interest is deducted before tax, as opposed to dividends, which are paid after tax. Interest deductibility. The second advantage is in relation to the interest costs. interest costs. Now, candidates, debt provides certainty in terms of fixed interest costs, and such predictability can aid in financial planning and budgeting for the company. It's known in advance, candidates, how much interest that a company ought to pay on debt or on loan, and that provides an element of predictability. The company can predict with certainty the costs related to debt, and that helps in financial planning and budgeting. 3, leverage for growth. Leverage for growth. Debt allows companies to leverage their capital base, enabling them to undertake larger projects or investments than would be possible with only equity financing. Leverage for growth. Number 4, there is no dilution of ownership. There is no dilution of ownership. Unlike equity financing, debt does not have voting rights, does not dilute ownership. The company retains control over its operations, and creditors do not have voting rights or claim on future profits. Debt does not lead to dilution of ownership like equity, and that is an advantage, particularly to the existing shareholders. Their control of the company is guaranteed when a company goes for debt, as opposed to when issuing new shares, which dilutes the ownership of the company. 5, diversification of the capital structure. What does that mean? Now, candidates, including debt in the capital structure allows for diversification and a balanced mix of funding sources, which may optimize the overall cost of capital. Diversification of the capital structure. These are 5 benefits of debt capital. Let's discuss the cons of debt, the disadvantages of using debt as a source of finance. 1, fixed repayment obligations. Fixed repayment obligations. How is that a disadvantage? Now, the fixed obligation to repay principal and interest can become burdensome, can be a burden, especially if the company experiences financial challenges, and failure to meet debt obligations can lead to default. Debt has to be repaid periodically, whether the company is making profit or not. And where the company is struggling to make profit, then it may become a burden on part of the company. And that is a disadvantage of having debt in the capital structure. The fixed obligation to repay, because we have seen here that one characteristic of debt is fixed obligation. The company must repay the principal amount at a certain periodically, all right? That both the principal and interest. And that can be a burden, particularly where the company is experiencing challenges, and such failure to meet debt obligations can lead to default. Interest costs, the second disadvantage. Interest costs. Interest costs. Now, while interest payments are tax deductible, the cost of debt includes interest, which represents ongoing expense for the company. And high interest costs can impact profitability. That is a disadvantage. Then we also have leverage risks. Leverage risks. Debt comes with leverage risks. Debt has an advantage of leveraging for growth, but at the same time, it comes with leverage risks. Leverage, we've seen, amplifies both gains and losses. Leverage can amplify both gains and losses. And while debt can enhance returns, it also increases financial risk, especially if the company's earnings decline or where the interest rates increase. 4. Collateral requirements. Some forms of debt may require companies to pledge assets as security, and that can restrict the company's flexibility and limits the ability to use assets for other purposes. That is a disadvantage. Collateral requirements. Collateral requirements. 5. Market sensitivity. Market sensitivity. Debt is subject to market conditions. Debt is subject to market changes. These are changes in interest rates which can affect the cost of borrowing, and that is a disadvantage. Rising interest rates may increase interest expenses for variable rate debt. Do you understand, candidates? Debt is subject to market sensitivity. Where interest rate increases, then that means that the fixed repayment in terms of interest will also be increased. Debt is subject to market conditions and also changes, such as increases in interest rates, which can affect the cost of borrowing. Can increase the cost of borrowing because it's sensitive to changes in the market. So these are 5 drawbacks of debt. We've discussed 5 advantages or benefits of using debt. We've discussed 6 characteristics of debt. The first characteristic is a fixed obligation. Number 2, there is a creditor's claim. Number 3, we have the feature on interest costs. Number 4, debt has a maturity date as opposed to equity, which represents a permanent source of capital. Then there is the aspect of leverage and collateral requirements. The first benefit of debt is that debt is interest deductible. Number 2, there is the interest cost. Interest cost, it can also be an advantage because the interest that is paid on debt is known in advance and is predictable, which makes it easy for the company to plan, to budget. All right, interest cost. Then number 3, debt can leverage growth. There is no dilution of ownership. Debt can also lead to diversification of the capital structure, which can positively impact the cost of capital. Then we have 5 disadvantages of debt. The first obvious disadvantage is debt comes with a fixed repayment obligations. There is also the interest costs. Number 3, leverage risks. Number 4, collateral requirements and market sensitivity. And that will mark the end of today's lesson, where we have discussed the characteristics, the advantages, and the disadvantages of using debt. And candidates, the use of debt involves careful consideration. The use of debt. We also know that debt candidates serves as a valuable long-term source of funds. That's what we said when we began this lesson. Debt serves as a valuable source of funding to companies, allowing companies to access capital for various purposes. However, the use of debt involves careful consideration of the associated costs, the risks, and also the company's ability to meet repayment obligations. So there ought to be a balance that is struck between debt and equity, which is essential for optimizing the company's capital structure and achieving financial sustainability. That's why we are studying the advantages and disadvantages of debt before considering to get debt, before considering to seek for funding from financial institutions or from bondholders. It's important for the company to carefully consider the associated cost of debt, the risks associated with debt, and the company's ability to meet the fixed obligations, fixed repayment obligations. That is the end of the lesson. I'll read our today's assignment. Number 1, what factors should companies consider when deciding on the appropriate level of debt in their capital structure? Number 2, how does debt financing differ from equity financing in terms of risk and return? And how do businesses balance these considerations? Number 3, explain the concept of leverage and its impact on a company's financial structure when utilizing debt as a source of financing. Thank you for attending the lesson. Bye.
Hi candidate, welcome to Manifested Online Classes. My name is Joseph Kemani, your lecturer for Advanced Financial Reporting and Analysis. So remember, this is one of the units which a candidate is expected to sit and pass at the advanced level of CPA. And the objective of this unit, or the objective of this paper, number 1 is to help the student to account for complex financial transactions. These financial transactions include accounting for things like deferred taxes, accounting for things like financial instruments, and so on. Number 2, a candidate should also be in a position to prepare complex or basically advanced financial statements, both for private and also the public sector entities. These include now the entities which are operating within the public sector, like what if as the county government, the national government, what if as the NGOs or the not-for-profit making organizations, and also a student should be in a position to prepare things like the group account and so on. So the other objective of this particular unit here is to help the student understand the current trend in accounting. For example, issues to do with sustainability reporting, issues to do with what we refer as the integrated reporting. So therefore, those are some of the objectives of this particular paper. And once the student sit and pass this particular paper, that particular student, number one, should be in a position to prepare the group accounts in accordance with the various international accounting standards and also in accordance with the various international financial reporting standards. So, I mean that once you have done this particular paper, you have passed this paper, you should be in a position to prepare group accounts in compliance with the various accounting standards. Number two, also a student must be in a position to prepare financial statements of various entities, including entities which are operating in private sector and also operating in public sector. Number three, a student should be in a position to analyze financial statements using various techniques such as computing things like earnings per share, preparation of something called the segment report, both for private sector entities and also the public sector entities. And also, a student must be in a position to account for complex financial transactions. I've mentioned some of them, including accounting for deferred taxes, even at the group level, accounting for things like leases, accounting for things like financial asset and financial liability. So therefore, those are the running outcomes. So once you have done this particular paper, and by the end of the day you have passed advanced financial reporting, then those are some of things you should be in a position to do. So in course of covering this particular syllabus, I will be providing summarized notes for each and every subtopic. And this particular unit here do have a total of 7 or a total of 6 topics, and each topic do have a number of subtopics. So what I'll be doing, I'll be providing a summarized note on the same, and also I expect that in course of covering a certain subtopic, you should also be in a position to take your own notes. And once we are through with a certain subtopic, then we will be doing some illustration questions. Usually, this particular illustration questions which we will be doing as far as this particular subtopic are concerned come from the Kasneb past papers, and actually the most recent Kasneb past papers. And also, other than doing a question or doing illustration question for each and every subtopic, I'll also be giving some assignment equally from the Kasneb past papers, which I expect you to attempt so that you can be able to have a detailed understanding of those particular sub topic. And in case you have any challenge in terms of tackling those particular illustration questions, or basically those particular assignment which I'll be giving in class, I usually encourage my student to procure our revision partner. We have a revision partner which is actually updated to the most recent sitting. So I usually encourage my student to procure this. It's basically available at a very affordable rate. Get a copy of this, and you'll be able to get all the solutions for all the assignment which I'll be giving in a class. So therefore, I welcome you in this class of advanced financial reporting. Again, I will be your lecturer for advanced financial reporting and analysis.
Hello student, my name is Isaac Juguna, and welcome to Manifest Publishers, and also welcome to this class today. And we are learning, today we are going to cover core application of data analytics. The subject we are going to cover today is a core application of data analytics under the subject known as application in financial management. Application in financial management. And the unit or other subtopic that you're going to cover is loan amortization. You're going to cover a subtopic called loan amortization. And in that case, what is the aim? By the end of this lesson, you as student, you're going to be able to prepare a loan amortization schedule. You're able to prepare a loan amortization schedule, and we do it using Microsoft Excel. We're going to do it using Microsoft Excel. And to start with, first you can see we are on our computer, we are on desktop. We are going to know how to create a folder where we are going to then open the Excel, then save. Creating a folder, we just right click, new folder. Let's say our folder, we call it data analytics. Then enter. Then after that, now we open Excel. Just start button, just click start button, then you open Excel, Microsoft Excel, or rather still you can just come and write there, Excel. Once you open Excel, it is very important you click blank workbook. So we start by saving it. We save it in our folder. So file, save as. It is we created our folder on the desktop. So we click here desktop. We choose our folder. Another state we can create it here. Call it it is data analytics. Let's write it in capital. Data analytics. Then enter. Just double click. Then let's we give a file name. In this case, let's call it loan amortization. We call it loan amortization. Then press enter to save it. So now we have opened our Excel, and we have saved. So now in this case, in a very simple terms, let me here as I am in Excel so that you are able to see it very well. Let's increase the font a little bit. So let's ask ourselves, what is loan amortization? What is loan amortization? What is loan amortization? So in this case, we can define it in just simple words. Basically, we say loan amortization, it is the process. It is the process of reducing. It is the process of reducing or paying off debt with regular payments. So we are saying that loan amortization, in this case, let me increase the size. So we are saying it is the process of reducing or paying off debt with regular payment. That is loan amortization. And in this case, to assist us to know how to do the loan amortization, we are going to have to do a simple question that is going to help so that we understand how to prepare the loan amortization schedule. Once again, let me increase the size a little bit. So let me, the question is that an investor borrowed a 6-year loan amounting 1.8 million, 1.8 million at annual rate of 12%, at annual rate of 12%. So we are required, let me increase the size still again a little bit. So required, or rather the question now we have been asked, required, we prepare, the required now, the question is prepare a loan amortization schedule. Prepare a loan amortization, prepare a loan amortization schedule. Prepare a loan amortization schedule. So let me repeat the question. So you're saying an investor borrowed a 6-year loan amounting to 1.8 million, and annual rate, at annual rate, borrowed, and that is at annual rate, that is at annual rate of 12%. So you are required, to prepare a loan amortization schedule. So that is our question. So now, using this Excel, how do we go about preparing this loan amortization schedule? So let me highlight where I want to work and increase just size a little bit so that it is very visible. So now, from our question, we have various things. We have the rate. We are given the rate, which is 12%. We are given the amount, and we are given the period, which is now 6 year. It is 6 years. So what we do, we just prepare a small table here. We come and write interest. Write interest that way. Then the other one we write, we have the number of years. We are given the number of years, which is a 6 year. So we can write number of years, number of years. And then the other thing we are given is the amount borrowed. We are given the amount borrowed. We're given the amount borrowed, so you just write it there. So that's what you have as per question. That's what we have. So now, for us to be able to prepare a loan amortization, so we are going to use a formula which we call present value annuity factor. That is, we are going to use present value annuity factor. So here we write that way, can write in capital, present value annuity, present value interest annuity factor. Then after that, we need to know the installment. What shall we be paying on a regular basis? So you write installment there. Just write in small letters. We write installment like that. Then after that, so in this case we have the interest, and interest from our question is 12%. So we write 12% there. Number of years, it is 6 year loan. So we write 6. Amount borrowed. The amount borrowed in this case is 1.8, or rather 1,800,000. Write our figure there, 1,800,000. Then from there, that's what you have. So here we can form a table. Here we call it year. Then after that, the years we have it is 1, 2, 3, 4, 5, 6. Then after that, we have the balance. We have the balance brought down. Then from there we have another column here, we call it interest. After that you're going to have the installments, and then let's just make it, or rather resize it a little bit. Then after that we have now the balance. Here we write balance carried down. So that is our table. So in this case, so that it is can be able to see it very well, let's just highlight. We put the borders. So borders is just home. Here we have where icon called borders. You click there, choose all borders. Just choose all borders. So meaning that now you can be able to view it very well, or rather let me make it much better. So let me click up there, alignment, then border. I choose a thick color a little bit, then I click outline and inside, so that now you can see this is the price of our interest, or rather we have now the table where we are going to work to do our calculations. So now in this case, very important, we have the interest, we have the number of years, and we have the amount borrowed. So how are we going to know the installment that you're going to pay every year? And in that case, or rather, what shall we be paying on a regular basis every year? So in this case, we say that we are going to use the present value interest annuity factor, and we have a formula for that. So we can just write that formula just here. Let's just write this is let me write in capital. Present value interest annuity factor. So the formula I'm going to use is this. We say that it is equals into bracket 1 minus into bracket 1 plus R, which is the rate, as R, which is the rate, then all that close the bracket, least power n, least power negative n, all that close the bracket, all that divided by R. So that is the formula we are going to use. So the formula for present value interest annuity factor is equals, that is 1 minus into bracket 1 plus R least power n, all that divided by R. So you're going to apply it here on our table, that is a present value interest annuity factor. So we write equals, you open the bracket, that is 1 minus into bracket, that is 1 plus R. What is our R? Is 12%. So you just click that 12%. Then you close the bracket, raised power negative n. N is number of period. So we click n, which is our number of period. Then after that, you close the bracket. All that, what you have written, we divide by, so you write divide by R. So you click 12% again. Then after that, you just enter. Then after that, you just enter. So if you click, this is now, you have seen our result is 4.11,140,7324. So if you click here, you check there at the formula bar, you can see we have written it is equals 1, that is equals into bracket 1 minus into bracket 1 plus R, R, which is 12%. In that case, it is dedicating I10 according to which column is and which row is. It is I10. You cross the bracket, least power negative n, which is indicating that it is I11. This one 6, I11, all that divided by the rate once again. So having done that, how now do you calculate the installment? To calculate the installment, you say that it is equals the amount borrowed, which is 1,800,000, divided by present value interests annuity factor. Then you enter. So now you can see the installment that you'll be paying on regular basis is 437,806.2932. That is the installment that you'll be paying on regular basis, or rather in the, our question, on yearly basis. On yearly basis, I repeat that to find the installment, you just write equals the amount borrowed divided by the present value interest annuity factor. So enter. Then after that, now we have our table here. The balance brought down. The balance brought down in this case, it is equals the amount we borrowed, which is 1.8 million. Then what will be the interest? The interest of that amount, it will be equals. We have our rate is 12% times the amount borrowed. Then enter. So I repeat, I've said that it is equals the interest rate multiplied by the amount borrowed, which is 1.8. Enter. So having done that, it is good that you click that figure. You can see where we have the I10, which stands for the interest. Since this interest rate of 12% is constant, so we lock it. We lock so that it can be constant. So to lock it is the shift and 4 in between the label I, shift and 4. That is $sign. You put $sign to lock it. Then after that, how do you find the installment? The installment is equals. It's just here, installment. Let me repeat. You click the installment, the cell for installment, you write equals, click the figure here, which is 437,806, enter. So this installment, still it is constant. Every year you are required to pay 437,806. So still it's good that you lock it. Shift R in between the label. Enter. Then after that, what will be now the balance carried down? The balance carried down, we say that it is equals what you borrowed, 1.8, plus the interest minus what have been paid the first year, which is 437,806. Enter. So the balance carried by the end of the year, the balance carried down, it will be 1,578,193.707. So what will be the balance brought down for the second year? It will be equals. You click the balance carried down for the first year. Enter. So what will now be the interest for that amount for the second year? So it is equals the interest times our figure now balance brought down for the second year. Enter. So we say that we lock the interest part. So we click here, $sign, and this other one, $sign. Enter. Then what about the installment? So the installment remain the same. which is this one, 4.7.806. So we click it. So still it's very important that also we lock it. Also we lock it, and again here we lock it. Enter. Then what will be the balance carried down for the second year? Once again, it is equals the balance brought down for the second year plus the interest of the second year minus the installment. So up to that point, you can see the balance brought down is reducing, and you can see also the interest amount. This is now the interest amount is also reducing. But what remains constant is the installment, what you are paying on yearly basis. Those regular payment, just from our definition, is what is remaining constant, or rather the amount is not changing. So we do the same and the same again for the other year. Let's still do for the third year. So for the third year, it will be equals. You click the balance brought down for the second year now. Enter. What will be the interest? The interest will be equals 12%. We click it, multiplied by the balance brought down for the third year. Enter. Again, it's very important that we lock shift 4, that is $sign in between the label I. Enter. Then installment, you click for that 726, that one remain constant. Also remember to lock it. Also remember to lock it. Shift 4 in between the label. What will be the balance carried down for the third year? It will be equals the balance brought down plus the interest amount minus the installment. So having done that, you might be having, assuming now here you have 6 years, you just do like that. But now it will be somehow tiresome if you do it manually for all those years. Let's say you could be having like 20 years. So doing one, it might seem to be very tiresome. So in this case, it's good that you have to do for the first year and for the second year. For the first year and for the second year, you do it manually, just like the way we have done it. You just do it manually like that. So to make it easier, so now I have deleted for the third year. So I come and highlight this second year, the whole of it. Then here you can see the plus. It's called the out of field hurdle. You hold that out of field hurdle, then you drag it down. You drag it down. So after that, you can see our figures here, the way it looks like. So highlight the whole of it, so that we format to numbers. So you can just click number, then number, you click OK. You click OK. You can see now we borrowed 1,800,000, and by the end of 6 years, we are able to complete the payment. We have now the zero amount here, meaning that we have finished, or rather we have completed our loan, which was 1.8 million. Very important to note is this formula is key. This formula is the one which is enabling us to do everything. That is the present value interest annuity factor. That is the key, which is equals into bracket 1 minus into bracket 1 plus r into bracket least power negative n, all that divided by r. And now in that case, we are able, we have managed to solve our problem. We have managed to solve our we have managed to do the loan amortization as for our question. So in that case, I'm going to give you a question so that now, applying the knowledge that you have learned here, you try to practice it. I'm just going to type it here at the end. So let me write, this is a assignment. An assignment we're going to give you is that an investor borrowed a 9-year loan amounting 3,600,000 at an annual rate of 13%. So an investor borrowed a 9-year loan amounting 3.6 million at an annual rate of 13%. So let me lap. Okay, at an annual rate of 13%. So in that case, what will be now the question? So you are required prepare a monthly loan amortization schedule. So the assignment I'm giving you is that an investor borrowed a 9-year loan amounting 3.6 million at annual rate of 13%. The question, or rather required, prepare a monthly loan amortization schedule. So kindly applying the knowledge that you have learned today, so kindly try to do that assignment. Thank you very much. I hope we have been able to achieve the objective of this lesson. God bless you.
Let's move on to the other model, which is the MVA, market value added. Market value added is yet another financial metric that measures the difference between two things. That is the difference between a company's market capitalization and the capital it has raised from investors. The difference between the company's market capitalization and the capital it has raised from investors. And this financial metric, candidates, reflect the value created by the company's management through its decisions and operations. So just like the EVA, it has very simple steps. So in calculating MVA, step number 1 is to calculate market capitalization. Calculate market calculate market capitalization. And this is done by simply multiplying the number of outstanding shares by the current market price per share. To calculate the total capital employed. So first you calculate the market capitalization. That is the market value of the shares. Market value of the shares. Market value of the shares. Then you calculate the total capital invested, which is the total sum of equity and debt that the company has raised from investors. Then you calculate MVA. Calculate MVA. Subtract the total capital employed from market capitalization. So it's a difference between the two. So when you subtract the two, you may either have a positive amount or a negative amount. A positive amount will indicate that the company has created value for its shareholders through the management's decisions and operations. But if there is a negative value, that suggests that the company has destroyed value for its shareholders. Market value added. Illustration. The following financial information relates to Steps Limited. For the year ended 30th September 2023, adjusted operating profit after tax NOPAT is 180 million. 2. Total capital is 900 million, no debt. 3. Closing market share price is 29 shillings. 4. Total number of shares outstanding is 86 million. The cost of equity is 13%. Required. Compute the following relative performance measures for Steps Limited. The following financial information relates to Steps Limited for the year ended 30th September 2023. Adjusted net operating profit after tax is 180 million. Adjusted. That tells you don't need to adjust anything. Number 2, total capital is 900 million, no debt. Closing market share price is 29 shillings. The total outstanding shares is 86 million. The cost of equity is 13%. Market value added. What is the market value added? So here we just get the difference of two things, the market value of equity minus the total shareholders' equity or capital employed. Isn't it not simple, that one? Illustration. Solution. Let's first do MVA. Market capitalization, which is the same as the market value of equity. Because you are multiplying what I've just rubbed here. I say that to get market capitalization, you will get the total value of the market price per share times number of shares. That will give you the market capitalization. So in this question, we are given the total capital, and you can see in bracket no debt. So that is the market value of equity. Then we deduct we have the value for equity, market value for equity. The total shareholders equity. So what is the market value of equity from the question? The market value of equity. So this will be 86 million shillings. Shares times 29 shillings. That is the market value of equity. We have the total shareholders equity from the question. From the question, shareholders equity. Look at the question. We have the total capital, which is 900. Then we have retained earnings. If you had retained earnings, you could have added it there. We don't have retained earnings. So the outstanding, the total capital, no debt, that means that is equity. Because total capital, candidates, total capital is equal to equity plus debt. Here we are told the capital is 900. The capital is 900 million. No debt. That means debt is 0. So the total shareholders equity is just 900. So what is the MVA? 1594 billion. 1594 billion. 1594. It is 1594 billion. So there is a point here. So if there is a point, we move how many times? 1, 2, 3. 1, 2, 3. 1, 2, 3. And candidates, if you are not very sure with the decimals, just go the long route. If you are not used to, because you will move 9 times here to come to this. 1, 2, 3, 4, 5, 6, 7, 8, 9. It's like Gilbert knows what he's doing. He gave us the right thing. 1.594 billion. Now, students who are used to exercising a lot, it's very easy for you to just round off, and you save a lot of time in your exam instead of writing all these figures. But if you are not sure, you'd rather go slow, you get half of the marks than lose all the marks because of rounding off. And the reason why some students say the time was short is because they were writing all these zeros. Here you write zeros, you write zeros. So you waste a lot of time. Yet the question is just in millions. It's just saying 86 million. So the examiner expects you to just write 86 million or 400 million, 400, 00M.
Welcome to Manifested Publishers. My name is Mr. Dongo. I am an economics lecturer, and I will be taking you through blocks, that is Economics, August 2024. I want us to start from question 1, and we start with question 1A, Roman 1. The question says that explain the concept of price ceiling. We note it down. Question 1, that is question 1. Roman 1. A Roman 1. Explain, we told explain the concept of the price ceiling. The concept of the price ceiling. The concept of the price ceiling. Explain the concept of the price ceiling. First of all, before we understand the price ceiling, we need to understand what we mean by price control. Because the price ceiling is an example of a price control. So we basically say that price control, these are actions that are taken by the government of artificially imposing legislation on the prices to be charged. We normally call them flat prices. And there are basically two types of price control. That is what you call the price ceiling or the maximum price. And the second type of price control, we call it the price floor or the minimum price. But for this question, the examiner has particularly touched on the price ceiling. So I want to say that price ceiling, when you say the price ceiling is the same as maximum price. So as a learner or the person doing exam, when you're given a price ceiling, you need to understand that that is what we call the maximum price. So it basically refers to the prices that are set by government above which commodity cannot be sold. These are prices that are set by government above which commodity cannot be sold. And to be precise, these prices are normally set below the equilibrium price. So we need to note them, price ceiling. This refers to the price. This refers to the price set by the government, refers to the price set by the government, above which commodity cannot be sold, above which commodity cannot be sold. Then you say it is set below the equilibrium, it is set below the equilibrium price. It is set below the equilibrium price. And I want to diagrammatically represent what you call the price ceiling or the maximum price. So we can have it down here. Down here is a quantity. Down here is the quantity. And this is the price. Down here is the quantity. And this is the price. So this is the supply. This is the this is the supply. This is the demand. Demand. We have what you call the equilibrium price, which is PE. So we say that the maximum price is basically maximum price or price ceiling. We call it PC. So price ceiling is set below. So what we experience here, we say that we experience what you call down here, what you call excess demand. Excess demand. We experience what you call excess demand. So I have given the meaning, and I've also diagrammatically represented the meaning of what you call the price ceiling. Maybe point to know on carrying out this in an examination. And very importantly, some of the things that students do not understand. You should understand that sometimes when you do not have the wording, you can also explain a meaning of a concept using the diagram. So essentially very important. And that is where most of the students do not get or do well in economics, because sometimes when they're not able to explain, they also forget about the diagram. But remember, if you remember the diagram, you can always explain. So if you forget how to explain, you can come up with the diagram. And in most cases, you find you will have a mark for that. That is question 1, A Roman 1. That is how we go about it. Roman 2. It says, discuss 3 advantages of setting price ceiling. Roman 2, that is question 1, Roman 2, A, Roman 2. Discuss, we call it discuss. Discuss advantages of setting the price ceiling. Advantages of setting the price ceiling. Advantages of setting the price ceiling. When you say advantages, we are basically talking about merits of setting a price ceiling. I want us to understand that whenever the government sets a price ceiling, it is always geared towards protecting the consumer. So one of the advantages of setting a price ceiling is to protect. One, we say to protect. We say to protect the consumer. We say that to protect the consumer against exploitation. To protect the consumer against exploitation by the producers. That is the first advantage. The second advantage, we say that this is geared towards giving advantages to the consumer. The second one is to say that to improve the living standards of the consumer. To improve the living standard of the consumer. To improve the living standard of the consumer. To improve the living standard. And the next reason why we set advantage of setting a price ceiling, we basically say to encourage consumption of a certain commodity. To encourage, we say to encourage consumption of a certain, to encourage consumption of a certain commodity. To encourage consumption of a certain commodity. And you can add one, or we can add one. We can add one. The examiner looked for 3, but we can add for 1. And that is to say to ensure, that is to ensure distribution, we call it to ensure the distribution of goods and services. We say to ensure distribution of goods and services. That is the 4th reason. And so the examiner was looking at this, discuss meaning that you can explain. And for each point, there's a 2 mark on this together. For example, when you say to protect the consumer against exploitation by the consumer, by the producer. Whenever prices are set below, we know that the reason why we normally have excess demand on that is because prices are set below. We know that when prices are low, demand is high. So basically, consumer are protected. The second one is to improve the living standard. By prices being low, we know for sure it brings the aspect of affordability. And so therefore, it brings about what we call improving the standard of living of the consumer. And when you talk about what you call to encourage consumption of certain goods, the reason why certain commodities, in most cases, we basically say are not consumed is because the prices are very high. So when you set the prices of those commodities below, we are definitely going to encourage that consumption of those very good. Something just to note to those that are preparing or those that are going through economics, you also need to look at this in addition. When we talk about those advantages, you also need to look at the effect, some of the effect as just an additional, going further above the question that we've done. What are some of the effects, of setting a price ceiling. I can pick one and talk about it, and the rest you can look into them in detail. One of the effects of setting a price ceiling, we basically say, is it leads to excess demand. Definitely demand is going to be very high when you set the prices below the equilibrium price or the maximum price. And that is how we get to that paper. That is how we get to that question. Roman B. I would love us to read it, then we note it on the board. It talks about describe 4 types of labor mobility. Describe 4 types of labor, 4 types of labor mobility. 4 types of labor mobility. The first thing to understand before you're able to answer that question, and that question is 4 marks. The first thing to understand is what is mobility of labor? We basically say that mobility of labor is basically the ease with which labor can move from one occupation to another or from one profession to another. And basically when you talk about the 4 types of mobility of labor, we basically have what we call geographical mobility of labor as the first one, geographical mobility of labor. And what is geographical mobility of labor? This is the ease with which labor can move from one geographical region to another, from one geographical region to another. This refers to, so we can note, refers to the movement refers to the movement of labor from one geographical region to another. From one geographical region to another. The second type of labor mobility, we call it occupational mobility. We call it occupational mobility of labor. Just to explain it before we note it down, this refers to labor moving from one occupation to another. For example, labor basically moving from agriculture to industry. Refers to the movement of labor from one occupation to another, i.e. from agriculture to industry, we pick on the third one. The third one, we call it what we call vertical. We call it vertical mobility of labor. We call it vertical mobility of labor. What is vertical mobility of labor? Whenever we talk about vertical mobility of labor, we're simply implying that labor can either move upward or labor can move through downward. And that basically, when you talk about labor moving upward, that is basically through promotion. And when labor moves downward, is basically through demotion. That is what we call vertical mobility of labor. So we refers to the movement refers to the movement of labor, from one job position to another. And vertically, we can say this can either be through promotion or demotion. This can either be through promotion or demotion. That can be either through promotion or demotion. And the last type of mobility, that is what we call horizontal. We call it horizontal mobility of labor. Horizontal mobility of labor. So basically, when you talk about horizontal mobility of labor, this is basically refers to labor moving from one organization to another. But the key word is that within the same job position, moving from one organization to another, but within the same job position. The movement of labor refers to the movement of labor from one organization to another, but within the same job position. Those are the four types of mobility of labor. Something just very important actually to think about is to also look at factors that basically influence mobility of labor. What are some of the factors probably that will make labor to move from one position to another? We need to understand some of the factors that really make labor to move from one area to another. We can also talk about aspect of education and training. We can also talk about agricultural development and many others. So as a learner or as a person preparing to tackle this exam, you also need to look at there. And lastly, very important, you also need to look at areas that are touching on advantages and disadvantages of mobility of labor. Advantages and disadvantages of mobility of labor. August 2024, that's question 1, Roman C. It says, enumerate 4 challenges of capping interest rate in countries. Enumerate 4 challenges of capping interest rate in a country. Before we provide solution to this very question, the first thing that is very important on our mind is to understand what is interest rate capping. Understanding interest rate capping, that is the first or the initial part of answering or giving solution to that very question that is on the board. I want to say that giving a background information, when you talk about interest rate capping, it basically took effect around 2016, and the essence of it was to aim at making credit available to a common man, making credit common to a common man. Actually looking at the lending rates of the financial institution and making them affordable to a common person, putting legislation to make lending affordable to the common man by the financial institution. And I want you to remember that I've said that when you talked about interest rate capping, it essentially came around 2016, and its aim was geared towards making credit available or affordable to a common man. So the government basically essentially put what you call a ceiling to the lending, by the commercial or financial institution. In our quest to do that, of course, the various challenges that are basically encountered when we try to cap the interest rate. One of the challenges we basically call it lack. We call it lack of. The first one is lack of cooperation. Lack of cooperation. What you call lack of cooperation from the financial. Lack of cooperation from the financial institution. Lack of cooperation from the financial institutions. That is the first challenges in capping interest rate. The second one, we talk about political. We call it political interference in the financial institution. Political interference in the financial institution as the second factor. The third factor is banks' excuse that there are no creditworthy. We call it the creditworthy borrowers. What you call creditworthy borrowers. We can pick on the fourth, creditworthy borrowers. We can talk about what you call corruption and mismanagement. Corruption, what you call corruption and mismanagement. Corruption and mismanagement in the implementation of the financial instruments. We talk about corruption and mismanagement in the implementation of the financial instrument. We can also talk about lack of political will as the last one. We'll pick a next one. Lack of political will. Lack of political will. We say lack of political will. Lack of political will to implement interest rate capping. To implement interest rate capping. Lack of political will to implement interest rate capping. Lack of political will to implement interest rate capping. If you look at that question, the examiner basically asked for four. Just something very important in relation to exam, and very important to notice that when you're doing such a question, it is very important to look for your stronger points. You note your stronger point before you put those very points that you're not sure of. You make your stronger points to be at the top, and those other points that you're not sure of, to put them at last. So spend most of the energy in looking at those stronger points. But very important is to understand that whenever you're doing any question, the first thing is to understand what the question is basically asking. A lot of times students get to these exams and thinking that at the end of the day they've gotten the question, but only to turn out that the questions were not as they thought. And the reason behind it is on understanding the question. So the foundation of answering any question is basically lying on understanding the question. So the first thing is to understand and look at the question clearly. Don't jump onto that question, but just look at the question keenly. Then the second step is to put appropriate answers to that question. That is how we go through what we call enumerating challenges for capping interest rate in a country. Question 1D. We'll read the question before we begin to tackle it. Describe 4 strategies that developing countries might apply to correct the balance of payment deficit. To repeat the question, describe 4 strategies that developing countries might apply to correct the balance of payment deficit. So we not in say, describe 4 ways, describe 4 strategies, not ways, 4 strategies that are developing, 4 strategies that developing countries might apply, developing countries might apply to correct the balance of payment, deficit, balance of payment deficit. The first thing in providing solution to such an answer is to understand what the question basically asks. The first thing is to understand what you mean by balance of payment deficit. When you talk about balance of payment deficit, where import is basically more than the export, meaning that the country is heavily dependent on other countries in terms of its growth and in terms of its development. We always say that what causes the balance of payment deficit is one of it is increase in export and essentially decrease in export. And we also say unfavorable terms of trade, that is TOT, unfavorable terms of trade. So essentially when you have a deficit, it's not good for a country. And that's why developing countries, when they get to that scenario, they need to look for ways in which they correct such deficit. We can talk about those things, then we put them on the board. One of the first ways is to encourage what we call export promotion strategy. When you talk about export promotion strategy, we are saying that we encourage exportation to foreign countries. We encourage export to foreign countries. That is what we call export promotion strategy. The second method we can talk about what we call import substitution strategy. This is deciding now to develop local industry or to produce through local industries that are basically in a country. So we can put those two, then we add the next. One is what we call adopting an export, what we call an export strategy, that is to say improving, exporting, we just say exporting to the foreign countries, to the foreign countries. That is the next. We have the second, what we call import substitution, adopting import, what we call import substitution method, adopting import substitution method, relying on, we basically say relying on domestic, relying on local industries to produce rather than to import. That is the second one. We can talk about the numbers that we have, what you call processing export. The next we can talk about processing export to improve trade. We can talk about next processing of export, what we call processing of the export to improve. We say processing of the export to improve trade. The next as processing of the export to improve trade. Basically processing of the export to improve trade. But we can also talk about increasing production, because this export basically rely on production of goods, So we say increasing production of goods and services. We talk about increasing, what we call increasing production, what we call increasing production of the goods and services, increasing the production of the goods and services, increasing the production of the goods and services. And lastly, we can add one, because the examiner talked about one, we can talk about forming economic integration. Having these developing countries coming together as a unit so that they become stronger. So we can say forming, a very good point. We say forming economic integrations, forming economic integration, hence making developing countries stronger in terms of trade, making developing countries basically stronger in terms of trade. And those are the ways that we can actually reduce the balance of payment deficit. That is how we go about looking at or solving balance of payment deficit issues in developing countries. That marks the end of question 1, August 2024.
So if we can start with task one. If you have gotten the worksheet, you should probably open it on your computer. If you have access to your computer, then we'll start with the tasks. So task 1 says insert a new row at the top of the worksheet and insert the heading. I think here, this one, I wanted to say insert the title, New Day Motors September imports. So there is a car dealer of some sort here. They've imported these vehicles. We have the cost. We probably be asked to do the duty, the shipping, and then the total cost. So what we want to do is follow these tasks, right? So if there is anyone amongst us, how do we insert a new row up here? We want something at the top of the worksheet. To insert a new row, we had not discussed this before, but I'm sure probably there's someone amongst us who will know how to do this. So I'll point at where the 1 is, number 1, and right click on that, and there will be an insert option. So just click that, you get a new row, right? So, and the same works for if I wanted to insert a new column and so forth. We don't want a new column right now. So what we want to do is insert that heading. Let's see, New Day, calling it New Day Motors September imports. So what does the next task say? Format the title to be bold and size 30. So we apply some basic formatting. So to format this, we will of course highlight it, then go to the Home tab and click bold. When they want it size 30, we change that here. Sometimes you will find that the size you want to put is not listed here. Like size 30 is not amongst these ones. So what do? We just type it directly and we get a size 30, right? So that's size 30. Then they want the cells merged in the range A1 to G1, right? I can see this font is already quite big. Maybe I should adjust the size. But let's see. Highlight this to merge the title, to merge the cells. We will highlight the range from A1 to H1. Then I will go to the Home tab and click on this Merge and Center. So it merges it within that range. The only issue right now is that it doesn't fit, so I can adjust a bit. What I've done is drag this a little to make sure that the whole of the title shows. Okay, I hope we're together up to that point. So that is formatting. Let's see. Yeah, there is one more formatting thing. We're supposed to apply visible table borders on the spreadsheet. We want some visible borders. So this part is going to be visible. So to apply borders, highlight the whole range where you want to apply the borders. Then we can again use the Home tab, and borders are here. So there is this font group, this ribbon, font group, borders, and click on borders, and you have borders there. Okay. That's clear. So let's try do some calculations now. We are applying some of what we have been learning. And this is where I want to get some interactivity out of you. We have been told to calculate duty. The duty, the rate for the duty is 40% for cars that cost 5,000 US dollars and below, and 55% for the rest. That means for vehicles that cost above 5,000, the duty is higher, it's 55%. So if anyone can recall from our discussions, what do we need to do here? What will we be using, a formula or a function? And if it's a function, what function shall we use? Okay, let me review this one for you. Now, we talked about the if function. The if function is a conditional function. Remember here, the condition is the duty changes according to the amount, the cost of the vehicle. So if the vehicle is above 5,000 USD, duty is this. If not, it is this other one. So it just sounds like an English sentence. So we have equals, then we start at the if function. If, then we will click this. So it should read like an English sentence. If the cost is above or equal to 5,000. Okay, if the cost is above or equal to 5,000, then what happens? So we have to have a then clause. This is called the condition. If that condition is true, then we have started with a greater than, actually, come to think of it, because here it says 5,000 and below. So we need to change this to answer the question correctly. We are less than or equal to, and notice the order of these symbols. You have to start with a less than sign followed by the equal sign. Sometimes students mix them up. You start with equals, then less than, and it doesn't work. So you put them in the order in which you say them. Less than or equal to 5,000. Then the duty is 40%. If you recall from our last lesson, I remember we did a bit of that function. You have to say 40% of what? If I just wrote 40%, then I'll get the wrong answer. Or rather, I'll just get 0.4 because 40% is 40 out of 100. I need to say 40% of what? 40% of the cost. Okay, so the duty is 40% of the cost. Else, so if this value does not meet the condition, the value in here does not meet that condition, then the duty is 55% of the cost. Right? Very important to remember there. Otherwise, there are some cases where a student will work out this. They will put the 40% and not put the value. Let's just see what will happen. if you didn't put 40% of what you're trying to get, you'll get this. And then you will wonder, why is my formula not working? Because you've not said 40% of what, or 55% of what. So you can use this to actually also check what rates are being used for the duty. Anything above 5,000, you'll see it is 0.55. This one is 0.55, which is 55%. So we need to specify it is 40% of the cost. That is how we do it. Remember, we have talked times about clicking on the options rather than typing them. Then when you click, that is when you're able to auto fill like we have done. We can also try the next one, shipping. Shipping is again straightforward. It is 15% of the cost for all vehicles. So that one should be a straightforward calculation, equals 15%. Okay, we said you use a percent sign. The percent sign is shift and 5. There are those people who will do 15 over 100 times the cost, which will still work, but there's no need to do that when you have the percent sign. So we use the tools that are available on the spreadsheet. So 50% of the shipping, or rather the cost. Then we drag this down, and then we have the shipping cost, right? Then the total cost, as you would guess, will be the sum of all this, right? So how do I get the total here using one function that we have learned so far? So select everything, including the cell where you want the solution. Then we can click on this auto sum sign. In fact, you can do all of them at the same time. So if I undid that and did this, then click on the auto sum, then you get all the answers. Okay, correct. This, it shows we are learning. Okay, so what we want to do is, so we have answered all that, we've calculated the total cost. What we want to do is also fill out this section here. We want to do a bit of analysis. Okay, so this analysis, I want to get the number based on every make. Okay, so I want to get, say, the number of Subarus, the number of Toyotas, and so forth. So there are different types of cars here. So I want to use the make field and get the number. So what I actually need to do here is to adjust this. See, instead of having this, do this, and then I'll move this. I can move this around. Again, part of it is, suppose I wanted to move this to the end. Let me put them here, so I can do my analysis around there. And instead of this, I will write names of every make. Toyota. Then I have Volkswagen. You can correct that even on the worksheet you received. And I think the last type of vehicle is Nissan. So that one is getting the number based on the make. But we can also do some analysis based on the category. So all of this is make. So I can merge that and put a small title there and say make. And then I've included an extra cell, so correct that by going back there to unmerge, and then merge afresh. Then I'll do some analysis here by category. So I'll just type a category. And there are how many categories? There is station wagon, then there is SUV, then I have sedan, then I can make this smaller, adjust this a little. Then I have what other category? Sedan, crossover. I think I have a van. Let me make this a van as well, instead of making it a minivan. Van. right? So what we want to do is to use some functions that we have learned also the past few days or weeks to fill in, to do some analysis on this. Before we learn new things, we need to master the ones we have already learned. So what we want to do is remind ourselves, what function shall we use if we want to display the number of Subarus, for example? How many Subarus are on this list? What function shall we use? Who remembers the function? Okay, so that is count. Tried, but not quite count. You've gotten it partially correct. What are we counting? When you use count, if I remember correctly, in the last lesson, we said if you use count by itself, count only counts numeric values, all right? We talked about count and count A. So we call these two. This one counts numeric values, and it will count everything in the range that you have selected. This will count, it will count string values or other text values in the whole range that you have selected. So we will need to use count if correct. Count if is a correct. So we are counting with a condition. So equals count if. Open a bracket. Then I like the range, and you need to specify what you're counting. So the criteria, and it gives you a prompt over there. So we have the first one we're counting is a Subaru. Said because we are now familiar with Excel, we don't need to go typing the formula over and over again. We can find a way of auto-filling the formula, copying the formula all the way, say up to here for make. We can even put, let's put some different colors here so that we see it is different type of data. I can use some green. I can put a green fill of that section and put some borders, and I can put a different fill here to differentiate the sections. Put a light blue fill, apply border. So I want to copy the formula here and here. Can anybody recall again from our discussion in the last lesson? There's something we said, if I tried copying this one directly, I'll get something that doesn't seem to be very right. First of all, I'll get zeros. And another problem is that it's still counting Subarus, right? So even if I change this, let's say I change this to Toyota. Let's see if it will give us the correct answer. Change it to Toyota. I still get a 0. So it's still not counting the things I want. But if you look carefully, this range is B3 to B14. But this range is C3 to C14. So it has moved from here to here. It's looking for Toyota here, and it can't find any Toyotas because that is a make, right? And you'll even get an error message, right? So what we want to do is to, while we are still here, we use absolute referencing. If you remember, we were pressing Fn and F4 to apply those dollar signs. So that locks the reference to that section, to that range. So if I copy this now, I get some 3s. So there's a bit of hope. At least I have something. It's not showing me zeros. The only problem now is easy to spot, that it's still counting Subaru when I need to change that to Volkswagen and Nissan. So I'll start with Nissan. I just need to change that to Nissan. And either type it. If I had a list of those types somewhere here, I could use that range. We'll check. I'll show you that in a minute. So Nissan, it tells me the 2. Then Subarus, need to change that from Subaru to Volkswagen. right? So it will count the Volkswagen, it finds 3, then we put Toyota and see how that will change. And those ones are 4, right? So, and you'll notice if you make any changes here, it will automatically be reflected. So what I'll say is, if I had this, a list of this somewhere, Toyota, Volkswagen, and I have the next one, Nissan. In categories, so I have Subaru, Toyota, Volkswagen, and Nissan. I can still use a range that is somewhere on the worksheet to do what I've just done. So if I kept this range, then instead of this Subaru here being there, I can click on this. So it will still look for Subaru. My search criteria will be whatever is contained in that cell. I hope that makes sense. Then if I want to drag it across, then it would make more sense if I put this one in this, somewhere in these cells. So if I put them across like that, then I will be able to autofill directly. So because this is referring to L14 now, so that is L14 where Subaru is, then I can autofill like this. And you see the numbers remain the same because this one has Subaru. When I go to the next one, M14 now has Toyota. So that's M14. If I go here, that N14 has Volkswagen, and that O14 has Nissan. So that's one way to do it. Unless this is, I don't think it's very confusing. Sometimes it saves you a few minutes of typing. If I had them here, then I would not have to go typing the names again there. But even typing will still give you the same result, right? I hope that is not too confusing. All right, let's try to apply the same formula to work out how many station wagons there are, how many SUVs there are, and so forth. Get the numbers by category. It will still be the same formula, so I'll do equals count if. Then I open a bracket, then this time I'm using this range, then I'll press F4, that is function F4 because I'm using a laptop. Then I put a comma, and I could do one of two things: write those the different categories here. Alternatively, just type them in directly. So let me just make the other point. So type them in, then I can do that. And if I copy this formula, I then have to go changing them. Like this one now will read station wagon, and I want it to read the van. I have to remember to change that one inside there to tell me there are 2 vans. Then I want to change this category to crossover to tell me how many crossovers are. There are 3. Then the next category is sedan. And so forth. Close the bracket. And there is SUV and so forth. Right, so we have used the count if formula. Remember, we have used that formula in very many different scenarios. The point is, presented with the different scenarios, you should be able to choose the correct function and apply it. Okay, so what we have done so far is we've kind of gone around the same functions in different scenarios to just make sure that you internalize their usage, their syntax, and their application. Okay, so let's talk about the average cost. We want to get the average cost by make, the average cost of a Subaru, the average cost of a Toyota, the average cost of Volkswagen and so forth, the average cost of a station wagon, the average cost of a US SUV. Average if, live and pop. So average if, then we have a criteria. So we want to get the average cost. So we'll use this total cost tool. Where are we looking for Subaru? We'll select that range, then lock it. We'll not go through the detail of locking again. Then what is the criteria? We are looking for a Subaru. So I can even use this directly. Let me lock that Subaru there. Shift and 4. Or I don't even need to lock it, but there's no harm. Then I'm doing the average of the total cost. So FN4, that should give the average cost of a Subaru. Okay, it looks like a very long formula, especially when you have the absolute signs. But just to break it down again, is let me expand it so we can make it slightly bigger so you can see it clearly. It says average if this range, it looks at that range for that thing. So it is looking in this range, which is that range, the make for Subaru, and then it will get the average of the total cost. So this is where it gets the value that it is working out the average of. So there's three, they're called parameters. This is a function with 3 parameters. It has the range where you're looking for that thing in the second section, and the range where the calculation comes from, right? So I'll put that back, smaller size, and remember shortcuts, I'm using Control-Z to move backwards. Then I can look at this and see the decimal points are a bit too many, then reduce those decimal points using this. We have land. Let's make it 2 decimal points because it's money. Then we go to Toyota. We'll use the same idea. If I autofill this one, so let's autofill this and see what the problem is. We get the same answer. So that's not a bad thing. It means there is only one thing we need to change. So those who are getting what I'm saying, what do I need to change in order to get the different values here? What do I need to change? Okay, so let me help you see it. So if I double click this, if you look at those variables there, there's range, criteria is the middle one, average range is the last one. So you can tell that this middle one is what is determining what the average will be, because this middle one is the one that represents that Subaru. Okay. So what I need to change is that middle one. Right now it's referring to the Subaru, so I need to change that to Toyota and change it on to Volkswagen and Nissan and so forth. So in fact, to make it easy, let me just use that. So right now it is C18, it means it's referring to that Subaru. If I autofill it, changes. So you'll notice that this changes to D18. That means it is now looking at the Toyota. If I look at this one, it has changed to E18. That means it is looking for the Volkswagen. If I look here, it's referring to F18. So what I needed to do is to change the criteria, because for all of them, it is checking here for that thing and doing the average based on that column there. I hope that makes sense. Right. So just to have a quick peek at that formula again, it has a range, it has a criteria, it has an average range. It works the same way for sum if. Sum if has the range, the criteria, and the sum range. So if you wanted to work out the sum, let's say total cost by, let's have a quick one here, total cost by make. So we'll see total cost by make. We basically need to, I can just copy this formula downwards. You see the logic of it. Let's see, it is going to C19. So I want this to remain as C18. If I do that, it gives me the same numbers. But it's giving me the same numbers because the function is still average if. So I want it to be sum if. I'll just change this to sum. And I'll get a sum of all the costs of the, let's say the first one will be Subaru. So it will take that number, 3875 plus 12,750, then add it to 10,200. That is where that number is coming from. So it works exactly the same way as the average if. It takes three parameters, the range, the criteria, and the sum range. Which range are you summing, right? So we'll use the same idea for getting the sedan. If we want to get the average, rather the category, if we want to get the average cost by category. Average cost by category, we'll use equals average if. It's the same formula. Then the range, this time we are using category, and we lock it. Then our criteria will be this one. Then close that. Then we still do the average cost, or rather the cost, total cost. Press enter, and we'll get this cost here. This 5,786 is the average cost of a station wagon. How many station wagons are there? There is 1, 2, 3. So that means it has taken these numbers, it has added that, plus that, and divided it by 3 to get that. So if you think about the math explanation for that. And because we have put the right references with this one, I can just copy it across. That is why it's important that you take some time and try this thing yourself. If you try it yourself, then you'll see the logic of what I'm doing, right? And try to get hold of this recording as well. So what I'll do is, this looks like too many decimal places. I'm going to review how you do decimal places. Do this, reduce them to 2 decimal places, right? Then total cost, I can use the same formula, similar formula. I'll just copy one of these down. I'll get some error message, and I will look at the formula and know that the thing that has changed is this one. Because these ones are locked, I will be guaranteed that they have not changed. So this G19 is what has changed. And if I look at it, G19 is the average cost, but we do not want or rather G19 is the number here. We do not want that as the criteria. The criteria is meant to be the category. So I just need to change this part, G18, that it's referring to the category. Then if I fill it across, it will give me the same numbers, but before I fill it across, because we are doing total now, we need to change that to sum, the sum function. Let's see, press enter, and then I can fill this across. So it is data that kind of makes sense. You want to know what is the average cost of an SUV. If I look at these numbers, they kind of tell me something. An SUV is on average more expensive than all these other types of cars, followed by some types of sedans, right? These are different types of cars. Then it looks like from this list, station wagons have the lowest average cost, okay? And then in terms of the total amount the dealership spent on importing the cars, the amount they spent, I think looking at these numbers, if I apply some formatting, right now they're not very clear. Because they are currency, I can put a comma on them. I put a comma using that. And now I can tell where the thousands are. So I can easily now tell the category that we spent most money on was SUVs, followed by the crossover, followed by the station wagons. Okay, so the total amount was highest on this. And again, like we're saying, this information, this formula can be used in different contexts. You want to know which products cost you the most, which products did you make the most money on, and so forth, depending on different scenarios. So let's try one more. Highest cost. This one is a bit separate from this, from the ones we've just done. We want to know out of this whole list, which one has the highest cost and which one has the lowest cost. And there's a function we learned for that. Again, let me throw the question back to you. Which function do we need to use to get the highest amount from a range? Max value, that's correct. So we have max equals, and max, open the bracket, highlight the range to pick the highest value at range. So 17,000 was the most expensive thing. It was a Land Cruiser, Toyota Land Cruiser. Then the lowest cost, we will use mean function, open a bracket, highlight this, then it gives you the lowest out of those figures. So the lowest was 3,875. Again, you can format this as, because this is currency. Generally with currency, we tend to put two decimal places. So if you look at it, this one has no decimal places, so I can quickly format all of them, select the whole range, then add some decimal places. Okay, so that makes it two decimal places. This one, I can make this two decimal places as well, and format it to have a comma, so I can see clearly where the thousands are, or in some cases, where the millions are. So let me put a comma there as well. It kind of makes it easy to read. Okay. So a number of functions we have reviewed there. Just a quick run through of what we have done so far. If you recall, the duty, we started with the duty. We used the if function. The if function in this case had three parameters, three things inside the function. So what I'm calling parameters are these things. There are three sections. There is the logical test. This is the test it will carry out. Then it will give you this value if that test is true. If that test is false, then it will give you that value. So it has three options. The condition, what will happen if the condition is true, and what will happen if the condition is false, right? So that's a basic if function. You could make it a little more complicated, but for our purposes, we will just be using relatively straightforward if functions. We will not use very complex if functions. There are some that are nested. You can make it have very, very many options, but for our purposes at the moment, we're just doing an if function with a condition. What happens if the condition is true? What happens if the condition is false? So that was the if function. For shipping, we didn't use a function, we just use a formula to calculate the percentage. The thing with the percentage that we have emphasized for the last two lessons is that you use a percent sign that is on your keyboard, Shift and 5. Okay, then you click on the number on the figures rather than type them. That is useful for when you want to autofill. Okay, so if I make the mistake of typing 2,500 here, then I'll have a problem. The first answer will be correct, and the rest of the answers will be wrong if I did that. gives me the same thing, or which makes everything else wrong. So instead of typing 500, I click on it, the center, then I can autofill. I get the other answer, correct answers, right? Then the total, of course, we did a sum function, we added all of them. So far, if function, sum functions, function. Then when we came to the analysis section, we've added 3 functions: count if, average if, then sum if. And with some practice, you'll be able to see the application of this. Like I can see Twadrimana there is getting the hang of it. And we said there is also these functions that we talked about, I think, in the last lesson. If I was to count the number of vehicles, in like the total number of vehicles, so I say total number of vehicles. Let me just call it total number. Okay, I want to count everything on this list. It depends on what I want to count. If I want to count by the make, notice that this is text. These are text values, not numbers. What would happen if I did count? If I did count, then highlighted this section, I get a 0. Then I would be very frustrated if I'm a student who has forgotten how to count text. So to count text, I need to add an A there. Small change, it gives you the correct answer. So count A is a function that is used to count text values. If I was to count this range here, if I counted the cost for whatever reason, you want to use that that range to get the number of vehicles. Then in that case, if I did this, let's see what will happen. I want to count this. This is money. Let's see if it will work. It still works. So you can use count A to count both. But in this case, because they are numeric values, even count by itself will work, right? So count A specifically for counting a string or text characters, right? Then in the same session, we have looked at formatting. Formatting is also an important aspect of spreadsheets. You can apply borders, which is part of the exercises I sent you. Applying borders is the home tab, going to borders and selecting all borders. Sometimes you will need to remove borders for if you're asked to remove some borders, then same place, and I say no borders. But in many cases, you will want to do borders, right? So that turns it into, if I wanted to print this, it's a bit neater. So if I went to File, Print, then the presentation is a little better than when it has no borders. Okay, look at it. Then color coding makes it a little better when you're printing. Just one more thing before while we're still talking about printing, if you look at this, at the moment, it's portrait orientation. So some things are running to the next page. So if I wanted things in one page, I'd probably need to make this landscape. I can make it landscape by going to page layout, orientation, and turn that into landscape. Okay. I do not want to print the tasks. These were for our use. So if I move this out of the way, you'll notice there is a dotted line there. So if I go to print preview now, that dotted line shows you what will be on the page. So you notice all of these fits now, and this part, some parts are outside, but for the sake of illustration, we didn't need to print to show the other bits. So the part that is missing is just that one there, which we can force that to get into the print area by moving this around. Okay, so we've also mentioned something about printing. Now, as for the next lesson, I'm targeting to start looking at slightly more, I won't call them complex, but there will be a bit more advanced function. So we'll start looking at something called the VLOOKUP function, which you expect to know. VLOOKUP. Then we will talk about things like pivot tables. We'll talk about some other functions that are more specific to accounts or finance, like PMT and so forth, a little more advanced. But we couldn't have gone to that extent without first understanding the basics. What I suggest is I will also, you have a copy of this already. So I suggest that you do the exercises. Take time to do these exercises. If you have questions, let's start with those the next time we meet. But just before we close again, while we are still on this, if I can quickly throw in something else, charts. We are supposed to learn how to make charts. So we can make, this looks like a good piece of some data to create a chart on. Suppose we wanted to create a chart based on the make and the total cost. It could be a bar chart, a column chart, a pie chart. So, but let's try exploring the different types of charts. If I wanted to select make and total cost, there are two ways to do it. One way is to select everything. Then I will go to insert and chart. Let's say it recommends that we do a clustered column chart, which is not what we want. Let's say we just want a simple column chart. Then we click OK. It gives me a column chart. Okay, so it is using, let me see that again. No, this is not what we are looking at. This is what we're looking at. So it seems to have picked duty and total cost. So let me go back there, then go to insert chart. I needed to see, I was expecting more columns. So if I do this and OK, then I get a chart looking like that. In this case, I don't need the line, so I get rid of it. Then it's showing me many variables. If you look at this, the blue one is the cost, the orange one is the category, then we have many variables. So, but I just want the make and the total cost. So I can remove from this the things that I don't want. So I can remove, when I look at this, it says cost, I don't want this cost, get rid of it. Then this is duty, and this is shipping. What I need to do is to edit this. I need to select different data. So I want it to show me this instead. So what I've done is edited directly. I've right-clicked on this, then gone to select data and highlighted the range I want. Okay. The alternative to doing that, like that looks a bit messy. It's a bit even confusing. Let's just not do that method. Method 2, you start by selecting exactly what you want. So I'll highlight that. Then I hold the control key on my keyboard. If I hold control, then I can select this one to avoid the confusion of having to delete some columns, then the chart looks a bit more confusing. I have highlighted this first, then hold down control, then highlight the next one. Right? So that way, when I'm inserting the chart, I will only be dealing with 2 columns, and it will be very straightforward. So if I click this, then it shows me the total cost and by make. Even the title will be meaningful. Total cost by make, right? Then I can even choose to, if you formatted this, you can vary the colors by the different types of data they have. I want to this. I can do vary colors by point, and then it will be able to show me different colors for different cars. But that's just a bit of some additional information. We'll still do a few more charts, I just wanted to give you a bit of a sneak peek into charts because it's also one of the basically to cover. Now, what I want to do is, because I don't want to overload you with too much information, I will let you do a bit of practice before you go to sleep today. Try and redo the things we have done. So if there's no questions, we'll end it at that. We'll see you next lesson.
Hello and welcome back to the lesson. Today we are still on the third bullet of the chapter, the financing decision, which is sources of finances for enterprises. During our last lesson, we made a distinction between internally generated funds and externally generated funds. Today we begin on another segment under the same subtopic. If you have a syllabus, you can see right after the externally generated funds, there is long-term sources, and there is an opening bracket, equity, debt, hybrids, lease finance, venture capital, business angel, private equity, asset securitization and sale, Islamic finance, and initial coin offerings. Those are long-term sources of finance which you are required to study. Then there is another category, medium-term sources, such as medium-term loans and hire purchase financing. Then there is short-term sources of finance, such as overdraft finance, trade credit, issue of commercial papers, accruals, deferred income. So those are the short-term sources of finance that you are required to study. So we will be going through each and every source of funds, finance that has been highlighted in the syllabus. And in looking or studying these sources of finances, we will consider the pros and cons of the various sources of finance, as well as the characteristics of each source of finance. I have highlighted the three categories: the long-term sources of funds, the medium-term sources of funds, and the short-term sources of funds. Today we begin with the long-term sources of funds. The first category is equity. In this lesson, we will study the characteristics of equity. We will study or highlight the pros and the cons of equity. Now, equity, candidates, represents a long-term source of funds for companies, providing capital contributed by the owners or shareholders. So equity is the capital that is provided by the owners of a company. Equity. So what are the characteristics of equity? Characteristics. Or features or attributes. We've said equity represents the capital that is contributed by the owners or the shareholders. The first characteristic is ownership stake. Ownership stake. Equity represents ownership in the company. It does what? It represents ownership in the company. Do you understand? And shareholders are the owners, and their level of ownership is proportionate to the number of shares that they hold in the company. So if a company has 100 shares, has issued 100 shares, and one individual has bought 50 of those shares, then such an individual has a 50% stake in a company. If an individual has just bought one share out of the 100, then such an individual has 1% stake in a company. So equity represents ownership in a company. Number two, equity has no obligation for repayment. There is no obligation for repayment. Unlike debt, where there is obligation to pay back the debt, equity does not involve a fixed obligation for repayment of principal or interest. Shareholders only participate in the company's success through capital appreciation and dividends. If you are a shareholder of a company, then you simply enjoy the dividends and capital or share appreciation. We can discuss the third characteristic under risk and return. Risk vis-a-vis return. Shareholders bear the risk of the company's performance. They share the risk of the company's performance, but they also have the potential for higher returns, especially if the company grows and the stock price increases. 4, voting rights. Voting what? Voting rights. Equity shareholders typically have the voting rights in major company decisions, which allows them to influence corporate governance matters, which also helps them influence board elections. Shareholders have voting rights. Shareholders have voting rights. 5, another characteristic can be discussed under the point dividends. Companies may distribute a portion of their profits to shareholders in form of dividends. However, the payment of dividends is at the discretion of the company's management. If the company's management feels that it is not appropriate to pay dividends, then the shareholders may not enjoy any dividends during that particular year. 6, perpetual existence. This is yet another feature of equity. Feature of equity. Equity represents a form of permanent capital contributing to the company's perpetual existence. When one buys the shares of a company, then that money, that capital that is contributed to the company has perpetual existence. It is that perpetual existence of equity that gives the company a permanent existence. Unlike debt, which has a maturity date, but equity does not have an expiry date. Does not have an expiry date. Perpetual existence. So these are 6 characteristics of equity. Let's discuss the pros of equity. The advantages. The first obvious advantage is that equity has no repayment obligations. 1, no repayment obligations. The company is not obligated to repay equity. Equity does not involve a fixed obligation for repayment. And that provides financial flexibility, especially during challenging economic conditions. Shared risks. The company's risks are shared. Shareholders share the business risks with the company. They only stand to lose the amount invested in the shares and are not personally liable for the company's debt. So we know a company is a person, is an artificial person. Shareholders may be artificial persons or natural persons. So the risks, the business risks of a company is shared by the shareholders and the person of the company. Shared risks. 3, equity attracts long-term investors. Attracts long-term investors. Equity attracts long-term investors. The issuers of equity can attract long-term investors who are interested in the company's growth potential, and that can contribute to stable and patient capital. 4, enhanced borrowing capacity. Enhanced borrowing capacity. A strong equity base can enhance a company's borrowing capacity by improving its overall financial health and creditworthiness. A company that has a strong equity base can borrow much more than a company that has a weaker equity base. Another advantage is that equity aligns interests. Aligns interests. What are these interests that are aligned by equity? Now, equity aligns the interests of shareholders and management, and shareholders benefit when the company performs well, fostering a sense of shared goals. Equity aligns the interest of the shareholders and the interests of the management. These are 5 pros of equity. We'll move to discuss the cons, the drawbacks, the cons of equity. The first obvious drawback is dilution of ownership. Equity dilutes ownership. Dilution of ownership. Dilution of ownership. Issuing additional shares to raise equity can lead to dilution of existing shareholders' ownership. And this dilution may affect the control and decision-making power of the existing shareholders. When you bring in new shareholders, then the existing control of the shareholders is diluted, because that control is then shared among the existing shareholders and the new shareholders. There is a dividend expectation. Dividend expectations. Shareholders may expect dividends, particularly if the company is profitable, and failure to meet dividend expectations can lead to dissatisfaction among the shareholders. As much as equity shareholders are not guaranteed to dividends, we say that dividends are paid at the behest of the company's management. The company's management decides if dividends will be paid or not. But on the part of the shareholders, by investing in a company, the shareholders expect that dividends will be paid, especially or particularly where the company is profitable. But if the company fails to pay dividends, which is possible or expected, then that can lead to dissatisfaction, and that becomes a drawback of equity. Now, candidate, the value of equity is influenced by market fluctuations, is influenced by economic factors, may be influenced by the sentiments of the investors. So equity is subject, the value of equity is subject to market fluctuations, to market conditions which are not stable. That would mean that the value of a share can fluctuate over time depending on conditions that are beyond the control of the company. Subject to the value of equity is subject to market fluctuations, or determined by market conditions. It's determined by the sentiments of the shareholders. Complex valuation. Valuation of equity can be complex. Valuing equity can be complex, especially for publicly traded companies. Why? Because share prices are influenced by various factors, including financial metrics, industry trends, market sentiments, and so on. Five, limited tax benefits. Unlike debt candidates, interest payments on equity, on equity are not tax deductible. They are not what? Tax deductible. And that can make equity financing less tax efficient compared to debt financing, limited tax benefits. So these are 5 cons of equity. We discussed 5 pros of equity. We've discussed 6 characteristics of equity. And in summary, candidates, we can say that equity serves as a long-term source of finance with unique characteristics, with unique advantages and disadvantages. And companies must carefully consider their financial needs, their growth objectives, and also preferences of existing shareholders when deciding to raise funds through equity. And there ought to be a balanced capital structure that involves a mix of equity and debt in order to maximize the benefits of both sources of financing. So these are characteristics, 6 characteristics. Ownership stake. There is no obligation for repayment. There is a characteristic in relation to risk and return, voting rights, dividends, and perpetual existence. We say that equity financing makes it possible for a company to have perpetual existence because the equity is not expected to be repaid. Pros of equity, advantages of equity, there is no repayment obligation. The company is not obligated to repay, as is the case for debt equity. There is shared risks between the company and the shareholders. It attracts long-term investors. Equity attracts long-term investors, which is very essential for stability of the company.
Hello learner, welcome to Manifested e-learning platform. My name is FAM Lingwiri, and today, ladies and gentlemen, we are discussing about the business data analytics, December 2023, question 22. It reads as follows: Safari Limited is evaluating a project with the following details. You've been given the initial investment, 100 million, residual value, 10 million, year one projected project cash flows is 25 million, the annual cash flow growth rate from year 2 is 10 million, the project life is 5 years. You are required: A, compute the following project metrics: payback period, number 1, number 2, the net present value, assume a discount rate of 12%, number 3, the profitability index, assume a discount rate of 12%. B, using a graph, determine the project's internal rate of return. And this totals 30 marks. So trying to answer this question gives us or gives you 30 marks there in total. So to start us off, we are first of all going to do the following. We're just going to first of all come right here and we say we have the year given to us over here. And this solution over here, I can just drag this one down over here. This is A, and this gives us year. So we have the years given to us there from year 0, 1, 2, and of course you know what happens. Once you put it like this and then you have that plus sign like that, you can drag it up to the number of years you actually want like that. So let's assume it goes all the way to year 5. Not assume, we've been told it goes to actually to year 5. And you can be able to see the project life right over here is 5 years. So from year 0. And we are saying from there, then we need then to put the value over here. We're dealing with Kenya shillings. So shillings, put shillings. And we are saying we can put them in thousands. That. All of these need to be put in terms of thousands over here. That. Why? Because we're dealing with thousands. We just do not want to deal with very big figures like that. We just want to deal at least with manageable figures. And from there, we can put over here the initial investment. That. Then we can put the initial investment right here as 100,000. Why am I putting 100,000? Guys, because you're saying that we are expressing it in terms of thousands over here. Yes, it's 100 million, but if you remove those 3 zeros there, we're saying we're dealing with 100,000. And because we want to deal with values that are in terms of the accounting format, so let's put it like that, then just do it sort of something like that. That looks at least well presentable, I mean. So initial investment is that. Then we have the residue value or residual value. That. And the residual value is assuming that you sell the asset at the end of the project or after 5 years there. So right here I can put over here in terms of the residue value, you can put 10,000 here. You sell an asset and you realize 10,000 in terms of value. Once that happens, then we can move ahead and look at the values over here in terms of the net cash flows over here, the cash flows. Cash flows. And you're seeing the cash flows over here we've been given. The initial investment is 100 million. You're seeing the project 1 cash flows is 25 million over here. So assuming that this is, of course, is the initial investment, we can put a negative value over here like this. We're saying that we can be able to put, so it's negative, I just sort of put negative, enter. It can be able to appear, and that it's an outflow. We can put the values over here as follows. For year 1, we're seeing is 25,000. Not put right there. You can put, because this is the residual value, the cash flows here, 25,000. That, and you're saying this 25 million or 25,000 over here, in our case here, is going to grow at an annual rate of 10% from year 2. So from here, we can do sort of something like so. We add that value and multiply it by a factor of 10%. So times 1.1. That. We get 27,500. Then we just drag it, because this has got a formula. We drag it sort of like that, and we make sure at least it auto fits within the cells. So from there, we are saying that what is going to be our net cash flows? Our net cash flows are going to be as follows. Flows. Then, so here we're going to pick this value here. The ones we're going to discount, these ones are going to use this value here. And then we are saying we're going to use, just going to pick the residual value plus the cash flow itself over here, if any. So that now it, after period 5, we expect this cash flow to be 46,603 over here to be the cash flow you're going to discount back to period 0. So we drag it and it picks. You can see now these are the cash flows you're going to discount over here. You can put them in bold, Control B. That, of course, we can be able to expand it by sort of clicking, double clicking like that. Those are the cash flows. Once we have that, we can then get the payback period. So over here, I can write now the payback period. Because that's what you're looking for, payback period. This means that we need to get the cumulative. Cumulative values. I can be able to just put it sort of like that, and we come right here and put it maybe in form of a box like that. So that's what you're interested in, the cumulative cash flows. So here it's just going to be that value, and then we're going to pick plus that value plus this net cash flow here, comes to 75, and then we reduce it. We continue, we drag it because it has got a formula. We continue up to there. But if we continue over here, if we get 33,000, we subtract, because of or 17,000, we subtract 33,000, we should be able to get a positive value. What the payback period tries to measure is how much you can be able to recoup this original investment of ours over here of 100,000. So clearly over here we'll be able to get a positive cash flow, yes. But in terms of the payback period, in terms of years, you can see the number of years given to us right here. We can say that the payback period, so payback period over here will be given to us right over here. So this is year 1. We can say year 1, indeed, we're still getting a negative cash flow. Here, year 2, we're still getting a negative cash flow. Year 3, we're still getting a negative cash flow over here. But when we reach year 4, we are going to get a positive cash flow. This, let me just demonstrate. We're just going to get a positive cash flow over here like so. And that's not what we want. We want to recoup this original investment. We do not want a positive cash flow. We want to see the exact number of years we're able to recoup this 100,000 right here. So just delete that. We know it is going to be 3 years, but 3 years and how many months? So we can be able to put the number of months right over here, or we can be able to compute it right here. So it's going to be that value over this value, and then we multiply by 12 because we want it in terms of months. Like that. So 6.22 months. So the payback period, you can see, is, we can say, is here. Payback period is 3 years, 6.22 months. That is what answers our first part right here, the payback period. So we can move ahead to part B, the question over here. And part B, we can just go down right here. B. It's a similar fashion or a similar format. We are looking for the net present value right here at a discount rate of 12%. So net present value. Net present value. And we're saying the net present value is, just given, is just how much we are able to get. Are we going to realize a positive cash flow or a negative cash flow based on discounting? You're using a discounted cash flow technique so that you can be able to get the present values. And in a similar way over here, so we're not in B, we're doing part A part 1. So this is A part 1. I can just put it like so. This is A part 2. A part 2, like that, so that now we can be consistent there. And to get the net present value, what we'll need to do, if you allow me to copy this over here like this, cash flow, the cash flows over here, I can be able just to copy these ones the way they are like that, copy, just put them just down here. So, and of course, I'll be able to also copy this. Allow me to copy this. Copy. Put it just down here like so. And this I can drag it maybe down. I can just drag it somewhere down there like that. So the initial investment, we pick it from above here. That's the initial investment there. No problem. The residual value, we just pick this from above here. And then we're saying the cash flows, we're just going to pick whatever we have right above here. So we're linking it like that. And we're saying these cash flows are the ones which we will need then to discount. So this is how we're going to discount it. So the net cash flows, we still pick them from above there. Net cash flows, like that. And then we have this value like that. And this is what we're going to discount. These ones over here. These net cash flows. You see like the way I've did over here, the relevant values, these are the ones which are we're going to discount and get the present values right over here. So present values. So the present values will be, we're going to get this value over 1 plus r over here. But for us to be able to get the present values, or there's in Excel, there's always a way we can be able to get the present values. Always. There's always a way how we can be able to do it. And we can just say the NPV. Instead of discounting this value over 1 plus the discount rate power 1, this value over 1 plus the discount rate power 2, power 3, power 4 and power 5 like that, we can just go to the to a formula NPV like that. And we are saying we open it up right here and we can see the rate. The rate is just 12%. And once we have the rate as 12%, under the value 1 here, we put in those cumulative cash flows like that. And then we will need then to subtract the initial cash outlay. So would it be correct for me to add right over here? We add the initial cash outlay there like that. That's the initial cash outlay. So that's what we are saying we are going to have. 13 million, of course, because we're dealing with millions, 13,365,000.99. That is what you're saying represents NPV. And so you can maybe highlight the answers maybe in red like that, so that you can be able to know that these are the answers. We can move on and discuss about the profitability index. The NPV, before we move on to the profitability index, the NPV is the net of present values to try and see whether you're able to get a positive cash flow or a positive value or a negative value. If NPV is positive like this, we accept the project because the project is going to yield us positive values in future. But if you get a negative NPV, then it doesn't make any sense to us here. So here, part 3, I can move ahead right down here and now click this one to be 3, the third one. That. A, part 3. We talk about profitability index. That. Under profitability index, we are going to get the present value of cash flows divided by the initial cash outlay. That gives us the profitability index. Any number greater than 1 gives us positive, or we are supposed to go ahead and invest in that project. If it gives us anything less than 1, then we reject the project. And we are told to assume the discount rate of 12%. So what we do is that we just go ahead and use similar values right over here. Copy. We come right here, or rather I should have copied from here, sorry. Copy, and you put it right maybe just down here. Paste special, we want to paste special formulas and all. Oh, it's refusing, so we just look for an alternative way, put it like that. So with these values, we can just link it with the first value right over here. So just link it with that one, that, and we can just drag it moving across like that. The residual value picks from here, that. So these represent the net cash flows. So this is what we're saying is shillings, so we just delete this and it's okay. But the initial investment picks from here, the net cash flows, that value there. So once we have that, then we can be able to get the profitability index. And the profitability index, we are going to get the present value of cash flows divided by the initial divided by the initial cash outlay. So we're going to use NPV rate 12%. The values, we are saying we're going to use these values here. And there's one thing that we needed to change here. We need to add the two values, these two values here, before we continue. That one plus that one there. See the profitability index, NPV. See here, double click it. Then we open it up right here. And you see the rate is 12%. And then with 12%, we can put in the values over here. like that. We are getting that value, the present value of cash flows, and we are going to divide this against the initial cash outlay. So minus, open the brackets, this one. Enter. That's what we get as our profitability index, 1.13. So in this case, we accept this one based on NPV, we accept, and the payback period, if it's the shorter the payback period, the better it is for us. So here, just like for consistency purposes, we put it in red like that. And we can see that we're moving on well, and we now move on to part B of the question. Using a graph, determine the project's internal rate of return. The project's internal rate of return is at the point where you get, the NPV is equals to 0. Where the NPV is equals to 0 is where we are saying our project's IRR is going to be. And so we're going to use a graph. So first of all, you're going to test it using the IRR formula. So IRR, or internal rate of return. Rate of return. The internal rate of return, IRR, is going to be, we open it up right over here, the values. So we put the values right over here, all of the values, including the negative value here. And we say, okay. So it's around 17%. And that's what we expect, or 16.75%. That's what we expect from using the graph, around there about. So he picks arbitrary rates, so 12%. You can put 12% over here, 13%, like that, and so on and so forth like that. So we just drag it. So we can just get arbitrary rates over here, and we get the corresponding NPVs. So NPV over here, 12%. The rate is 12%. You can see from right over here, 12%. The values over here are these ones here, the net cash flows here, like that. And then we do what? We add the initial cash outlay. The initial cash outlay in this case was negative here, that, and we get that value. So it's the same as what we got above over here. That's fine. But because we want to ensure that we want to get the corresponding NPVs at different rates over here, I need to lock the formulas over here. So I press F4 there. I click over here, I press F4, and I press F4 over here, so that I can be able to lock and ensure that everything is okay. So if I drag my formula over here, it should be able to work. So that's what I'm going to do right here. So shift, Control D. But it's picking 13%, or it's because I didn't change. You see, it's still at 12% here. So what I'll do, I'll just change this to 13%, 14%, like that, 14%, 15%, and so on and so forth. Just come and change here, 16%, 17, that, then 18. So don't worry about that. 19, Then here we got 20%, 20%, like that. So you plot a graph over here. This is the NPV. NPV, that rate. Like that. So just sort of put it center to make it look presentable, and like that. Then you can just draw a graph here. Insert. Then you come to recommended charts, and you can be able to see, based on this graph over here, that point, okay, just place it somewhere right here, that at around 16% over here, you can see at around this point here, if you click right here, it will give you the point. At around 17% is when you're going to get negative NPV thereabout. 17%. And you can see it's 16.75 right here. So the exact rate should actually be somewhere over here where it's next to. It's along just this curve over here. It cuts it along this axis over here like that. NPV indeed is at 16.75. So once you draw the graph like this, it should be able to, and then you just highlight like this, you can be able to see thereabouts around approximately 17%. You can be able to get the IRR. So ladies and gentlemen, this brings us to the end of the class. We have done question 22 of the business and data analytics paper, which came in December 2023. Hope you have enjoyed it. God bless you all. Bye bye.
A commission in this case, it is only one partner, who is Kidore, who was entitled to a commission of 3,000. And then we have now salary. So we don't have salary, but in the event you had salary to partners, you equally credit it in this account. And then next we have interest on capital. Interest on capital for Chada 5850, that is 700, and that 150. So we are through with that. And then finally we have the share of profit. Share of profit. So therefore I've said all appropriations, we credit them here. So we have 30, 120, 30, 120, and 15, 0, 60. So we are through with that. Let's go back to the trial balance below. The profit for there we have drawings. Now the drawings, basically that one in this account is supposed to be debited. The drawings to partners, we have the drawing for Chada 78, for the other partner 6,500, and for the other partner 39. And then finally we have the partner's current account. Now the partner's current account, equally we cross it off to the partner's capital account, and you can see those particular current accounts, they had credit balances. So we take those particular credit balances, we bring them in this account on the credit side. If the balances, if any of the current account is having a debit balance, that should be recorded on which side? The credit side. But none of the current account there is having a debit balance. So all of them are credit what? Balances. That's why we have said we cross them off in this account on the credit what? On the credit side. On the credit side. So basically in our case, you can see what you have done. We have crossed all items which had balances at the end of the year, either in the realization or in the partner's capital account. Then let's go through the additional information. We see whether there is anything we need to capture here. So I think we have dealt with note number 1 about the commission to Kidore. Note number 2, whereby we are given the terms of conversion. We have accounted for the investment which were taken over. We have accounted for the other assets which were taken over, including landed buildings, motor vehicle, office equipment, fixture and fittings, inventory, account receivables. We have also accounted for current liabilities which were taken over, which included account payable, bank overdraft, accrued expenses. We have also accounted for the goodwill which was written off. And then we have also, okay, there is something we are yet to account for there, that is purchase consideration. We say that this purchase consideration, which was agreed upon, or the purchase consideration now which the partners are supposed to be paid, that one is debited, not debited, rather credited in the realization, and is an amount of 250 million. We credit it in this account and then we debit it in this account here, which is called purchasing company account. Remember, all our figures here are in thousand of what? Of shillings. So we have the purchase consideration, an amount of 250,000. So we are through with that. And then we are told the partners became shareholders and were issued with the share. So basically what that means is that this particular purchase consideration will be paid to the partners of the partnership business by being issued with the shares of the new company. So automatically what that means that those who are partners, that is Chanda, Pet and Kidore, will equally become the shareholders of the new what company, because they will be paid the amount due to them in terms of being issued with the shares. And then note 3, we are given information. We are told upon incorporation, the new company issued debenture. So these are a transaction by the new company, not by the partnership. So therefore, in our case, I think first of all, we are through with preparing these three accounts. So what we need to do now is to balance off this account. But the first thing which we do is to balance off this account, and the balancing figure in this account is either a gain or a loss on realization. A balancing figure on this side is a loss on realization. A balancing figure on this side is a gain on realization, which is equally shared among partners using their profit and loss sharing what ratio. So let's balance this particular account here. Let's balance this account. So let's start by getting the total on the credit side. We have 5,200 plus 62,400 plus 17,550 plus 4,000 plus 250,000. So that will give us a total of what? A total of 339,150. What about the total on the credit side? We have 103, 350 plus 26,000 plus 45,800 plus 33,500 plus 31,200 plus 25,400. So that will give us a total of, this is the total on the credit. The total on the debit is 265,250. So basically what that means is that the amount which is more is the amount on the credit side, which is 339,150. 339,150, and that means that we have a balancing figure on this side, and I've said a balancing figure on this side is what? Is a gain on realization. Is a gain on realization, and that gain on realization is shared among partners using their profit and loss sharing ratio. Gain on realization. This will be shared between the three partners, that is Chada, Pete and Kidore, using their profit and loss sharing ratio, which is 2 all over 5, 2 all over 5, 1 all over 5 times now the gain on realization. So the gain on realization will be the difference between those two figures, which is 73,900. 73,900. 900. Yes. So let's determine the amount to be shared, or the share of each partner. So here we have what? We have 29,560. 29,560. Okay, no. That correct? Yes, 29,560. And then we have 14. 780, 14,780. Okay, yes, we can just confirm whether that is correct. Yes, that will give us what? That will give us 73,900. So this particular amount, which is shared among partners, then it is crossed off to this particular account. You can see this account is being debited. So what we do to complete the double entry, we credit this account, the gain on realization. So we have 29, 560, 29, 560. And then for the last partner, who